In April, giving the Fed scope to pause rate hikes. Meanwhile, Treasury Secretary Janet Yellen warns a debt default would spark a global downturn. More hikes in Europe. The Bank of England is set to raise rates for a 12th straight meeting today. The ECB's Joachim Nagel tells Bloomberg the central bank is getting closer to restrictive policy, but isn't there yet. Plus, Jamie Dimon exclusive. We will be speaking with the CEO and chairman of JP Morgan Chase at the bank's annual Global Markets Conference in Paris, a conversation you do not want to miss. Let's check in on the futures then. Currently pointing to gains of around 0.3%. The first time the inflation print in the US has come below 5% in 2 years. You saw the movement in yields and reflect that shortly, but the read across in terms of how markets are thinking about a pause coming through from the Fed. Currently for the open then, you're looking at the CAC current down 0.5%, if that is indeed an accurate reflection. I'm not seeing a lot of movement in terms of these European indexes. We have been hearing from Joachim Nagel. That's been a sit-down interview with Stephen Engel over at the G7 in Japan, talking about the proximity to restrictive rates from the ECB. Of course, front and center for us today in terms of the central banks is the Bank of England. Expectations from most economists that you're going to get another 25 basis points. The big question is what you hear from the central bank governor, of course, of the UK in terms of the next steps for the Bank of England as they weigh up still very high inflation rates with a particularly, or at least surprisingly resilient economy. Currently, the CAC current turning green, currently adding 27 points, 0.4%. Let's move over cross asset and to see how things are shaking up then. With the 2-year yield, you saw that 11 basis point move lower in yields yesterday on the back of that inflation print. You're currently then at 391, so significantly and comfortably below that 4% level. Not a lot of movement in the yields today, just digesting the moves of yesterday. Iron ore is a story that ties in to what is happening in China. The inflation prints suggesting that the economic rebound is looking a little fragile in the world's second largest economy, but there will be bets that there will be additional stimulus coming through. Currently, though, iron ore down a full 3.6%, again, on the fragility of that economy. And so far, the moves in terms of stimulus from officials out of Beijing have been moderate, to say the least. Futures in the US have pointed to gains of 0.2% building on the upside that we saw yesterday. The Nasdaq, by the way, gaining, just for the context, year to date, around 22% and getting to highs last seen in August yesterday. Euro dollar 109, just a little bit of softness coming through for the single currency, down 0.4%. Now, Treasury Secretary Janet Yellen says a US government default would undermine Washington's ability to provide international leadership. Speaking at the G7 summit in Japan, Yellen called such a scenario, quote, unthinkable.
A default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced. American businesses would see credit markets deteriorate, and millions of American families that receive government payments would likely be left without the resources that they were promised.
And do not miss our exclusive conversation with Janet Yellen. That is tomorrow morning at 8:30 a.m. UK time. Now, US inflation, as we mentioned, showed signs of cooling in April, opening the door for the Fed to pause rate hikes soon. CPI rose by 4.9% from a year earlier, marking the first sub-5% reading, as I mentioned, in 2 years. For the analysis on the inflation front, central banks, and how to position in this environment, let's bring in Vivek Paul, Senior Portfolio Strategist at BlackRock International. Vivek, good morning. Thank you for joining us in the studio. Let's start there then with the CPI print out of the US. We saw the importance, and we know that the Fed is focused on this, services coming in slightly softer than expected. Rental as well, the housing, the shelter costs coming in slightly lower as well. Are you starting to change your views on how inflation is evolving in the US?
So it's of course encouraging that we're seeing some more softness there, but you've also got to remember that's not the entire full story, right? Of course, goods inflation kind of surprised to the upside a little bit in that picture as well. I think the key point is, what does that imply about where inflation is likely to settle at in the near run and slightly beyond? And for us, the thing we're worried about a little bit still is that dislocation between the likely inflation outturn over the course of the coming months and the price of rate path that is effectively coming into the market expectation at this moment in time. Despite the fact that those numbers are comparatively encouraging, it's not consistent with the idea of effectively imminent rate cuts that effectively the market is starting to price in. And that dislocation, that means for us, not all of the damage potentially in terms of this is priced into market.
So it doesn't really fundamentally challenge the view by BlackRock and the team, and you've been consistent on this, the team, that inflation is going to remain stickier and higher, but the central bank response will not be necessarily drawing from history and cutting quickly, and that we have to live with higher inflation. Doesn't challenge that view. Let's bring you in on the Fed pricing then in terms of the views around the pause and hold view from BlackRock and the team. Where does that, how long is that extended into 2023? When does that start to change? When do you see the pause going to a cut? You don't see cuts this year. Early front end of 2024 or later?
Yes, I think it's always difficult to be precise about exactly which quarter is going to occur, right? There's always going to be potential for surprises to inflation. We've heard some stories already today that kind of might influence the broader central bank thinking. It's very hard to kind of be precise about the exact date. I think the key point is if you look at that cumulative path over the course of the coming years that markets are pricing relative to what we think will actually anticipate, will actually occur, there's a gap there. And effectively, markets are effectively anticipating this old playbook, whether or not it's precisely this quarter or that quarter, it's the old playbook of effectively central banks coming to the rescue, not necessarily believing in that sort of stickiness and persistence of inflation drivers. And that's the thing that I guess is the worry, that effectively there might be some element of a snap back to the path that we anticipate, which is a little bit more punitive in terms of risk.
So how do you trade that mismatch?
Well, I think it's difficult, right? One of the things that we have been talking about for a while is, in the near run at least, being a little bit cautious around some of those developed market growth assets, particularly in the United States, because, for instance, they are in part supported by the idea of the central bank inevitably coming to the rescue. Now, that is fundamentally something that we think will play out over a 6 to 12-month horizon. Thereafter, there's going to be strong opportunities in exactly the same sort of space, and indeed, our longer-run positioning is positive around stocks, because if you can afford to look through that, that's where you'd start from. And so I think it's really a question of time horizon. It's a question of what's likely to occur in the next 6 to 12 months and what's likely to occur thereafter.
Can you afford to look through the debt default ceiling risks? We heard again from Janet Yellen and the President, Joe Biden, warning of the global risks of this event. Can you afford to look through it?
It's always difficult positioning around something that is sort of low probability but very high impact, right? And I think the way in which we think about it right now is that the volatility that this could inspire is likely to continue for a period of time. Both sides are still comparatively far away, and as a result, there will still be some volatility positioning around that. Ultimately, the central case, it is a low probability for a reason, so we should be cautious around it, but it's not something that I think you do anything other than just be cautious in terms of your near-term positioning.
I want to just loop back to the inflation conversation, because we had the CPI print and the PPI print out of China as well. Can we, reading into that, softer than expected, can we then dismiss the idea that China is going to be inflationary as it continues its economic recovery? That was a concern on the reopening. Can we now put that to one side?
Well, I think it is striking, isn't it? The problems that China's facing relative to the United States around in terms of that inflation dynamic are just completely polar opposite, too low versus too high. I think the thing that kind of we have been talking about in terms of the developed market is the sort of structural drivers around inflation and the drivers in the near run are less to do with that reopening dynamic. It's more to do with, for instance, the changing the nature of the labor supply, the fact that people have kind of exited that labor force, we're still kind of waiting that labour supply to come back to some degree. They're the bigger drivers in terms of the near-run picture. Similar story in the United Kingdom, which I'm sure we'll come on to, as well as some other broader points there.
Okay, Vivek, excellent. Yes, we will indeed. We'll come to your views on the BOE after the break. And as well, the industrial real estate sector in the US. Vivek has some interesting views on that as well, some opportunities maybe to look at. Vivek Paul, Senior Portfolio Strategist at BlackRock International, staying with us. Coming up, sticky inflation is fueling bets that the Bank of England will raise rates again. We get Vivek's views on that, the latest outside the Bank of England. We're going to hear from the BOE governor himself later. That's at 4 p.m. London time. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I think, first of all, it was important that we hiked rates last week. I think it confirmed our commitment that our monetary policy path is not over to fight against inflation. Inflation is still very sticky. It is a very stubborn phenomenon. And as I said several times, you have to be even more stubborn. That means for me that story about hiking rates is not over. We have to do more. So there are 2 more meetings before the summer break, and let's go.
So you said that it was likely in the home stretch, whereas Christine Lagarde has talked about there's still more ground to cover. And inflation has been stubborn, and core inflation has been stubborn in Europe, and it's seen picking up in places like Italy. So 2 more possible hikes by July. What about September? Is that off the table or definitely a possibility?
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
Mm-hmm. How long would if they pause in July, how long a pause would you anticipate? I think the longest time that they would stay at that peak has been 7 months or so. Would you see that as a good benchmark?
So again, I do not know where we have to stop. But when there's the point coming that we could more or less stop the rate hikes, then I have to believe we have to stay there for a while to wait what is the impact, what we did from the past, to see are we really successful or not. And this is very important.
Well, how long of a sustained drop, if you will, in core CPI would be enough?
I think what I see in the numbers is that it will take at least 1.5 years till we see numbers that are close to our target. So we have to be patient here.
I know Barclays was predicting a pause, and a pause until the second half of 2024, and then hikes. Is that something that would be feasible, or is that too far to predict what the data might say?
This is maybe would be also speculation. So what I see is that we have to wait for the incoming data, and then we will decide. So this meeting-to-meeting approach, this is the right way to do monetary policy in these days.
Okay, that was the Bundesbank president and ECB Governing Council member Joachim Nagel speaking exclusively with Bloomberg's Stephen Engel at the G7 on the sidelines of the G7 in Japan. Now, stubborn double-digit inflation is set to force the Bank of England into a 12th straight interest rate hike today, even though the end of its lightning-quick hiking cycle is coming into view. Bloomberg UK correspondent Lizzie Burden is outside the Bank of England for us this morning. Lizzie, what can we expect?
Well, Tom, markets and economists are pretty much in agreement that we're going to see a quarter-point hike today to 4.5%. But the real focus today is on the future path for rates. When will they peak? Where will they peak? Markets reckon there's a pretty strong chance of it being 5% by September. But we were speaking on Bloomberg Radio yesterday to Sushil Wadhwani, former Bank of England policymaker. He said that level would be unwise given the potential spillover effects of a US recession, given all the recent US regional banking turmoil. In terms of the rate split today, economists are looking for 7.2, same as last time, but the risk being that hawks on the committee are spooked by that double-digit inflation surprise that you mentioned in the latest data. But at the same time, you've got doves on the committee like Silvana Tenreiro who say to be a hawk right now would be like being a fool in the shower. Keep turning on the hot tap, impatient for the hot water, and scolding yourself in the process. She says you need to sit tight and wait for the previous jumbo hikes to kick in.
Yeah, the doves on one side, maybe those hawkish members looking at 50 basis points, potentially. What kind of forward guidance will there be, do you think, Lizzie?
Well, of course, the Fed has already signalled a pause, but in the UK context, we've had surprise after surprise when it comes to the data. So you have to ask how credible the Bank of England can be if it gives detailed forward guidance. Some are asking, should they have been less dovish earlier in the cycle? Is it too late for tough talk now? Apart from the presser and the interviews, I know we've got one coming up with the governor this afternoon, I would also just look at the forecast for inflation for hints about the future path for rates. Economists surveyed by Bloomberg reckon that you're going to get an upgrade to the inflation forecast, not just for this year, but for next and 2025 as well, given that we've already still got double-digit inflation. And it'll be interesting as well to see where the Bank of England reckons inflation is going to end 2023, because, of course, it's #1 priority for Rishi Sunak to halve inflation by the end of the year. But we heard from NISA, the think tank, yesterday, saying that may not be possible. And indeed, perhaps it was irresponsible to set that target because it interferes with the Bank of England's inflation-fighting mission. We'll see where the Bank of England reckons inflation will end the year at 12 o'clock today, Tom.
Okay, scrutinising those inflation forecasts from the Bank of England. Lizzie Burden, outside the BOE, thank you very much indeed. We will bring you the BOE's decision, of course, at 12 p.m. today, and special coverage of the news conference. Bloomberg's Guy Johnson will be sitting down with the BOE Governor Andrew Bailey. We're going to bring you that interview today, 4 p.m. London time, so definitely tune in for that. Now, Vivek Paul, Senior Portfolio Strategist at BlackRock International, is still with us. Vivek, then, on the BOE, can they afford to signal a pause?
As Lizzie's rightly said, you know, the more prescriptive they are, the more they're holding themselves a hostage to fortune. I think this just kind of shows how difficult it's been for them. That trade-off of kind of stabilizing inflation, stabilizing growth is so hard for developed markets the world over, but it's almost particularly for the Bank of England. The fact that it is still, at the moment, double-digit inflation, of course, that's going to come down materially, but the fact that core is multiples of their target, and the fact that when you think about the growth picture now, it's been a while of around about no growth. Whether or not we've technically avoided a recession is secondary to the fact that it's been basically flat growth. It's projected to be basically flat growth for the period of time to come. So this dynamic is more acute for them than almost anyone else.
So this is the most tortured central bank at this point?
Not the words I'd use, but I think clearly they are faced, they're at the coalface here in terms of that sharp trade-off, that kind of new regime dynamic that we've been talking about, that sort of balancing those two competing factors. It is more difficult for them in some ways than many others.
Do you think they get to above 5%, or what's the terminal rate you're looking at for BOE? What's your projection?
So, I mean, today, as already mentioned, is kind of incredible surprise if it's anything other than that 25 basis points. I think what we need to look for is kind of how they talk, but not just about the inflation path, but also about the growth path when we're thinking about today. Because, you know, how do you view that near-term resiliency? Is that, in their eyes, effectively, or do we read into that effectively just means they need to do more in the future? Or is it effectively the fact that some of the lagged effects from the rate rises we've already seen have yet to come through? So understanding how they view that dynamic, I think, is also going to help us understand how they view that trade-off and how that'll play out.
Just briefly on the ECB then, inflation rates are lower compared to the UK for the Eurozone. You got a line in your notes to us on the ECB. They are going to go full steam ahead with rate hikes. Just unpack that for us.
Well, I think this point about the trade-off that we're talking about here, right? And if you think about the ECB, think about the Bank of England, there's more of that primacy of the inflation mandate than there is potentially for the Federal Reserve. So if you think about the balance of what they're trying to do, perhaps that is part of the reason why, you know, they are still yet to be done, as we heard from the correspondent earlier. And I think that dynamic doesn't mean that there is no trade-off to be had. There is, but I think they are kind of veering towards one side of it for the foreseeable future.
You've talked, you know, there's been a lot of scrutiny around other cracks. We've looked at the banking system. That continues to be an issue, of course, but US real estate has really come to the fore in terms of a potential risk factor, another area that could crack as these rates continue to rise. But you also say there are potential opportunities within the mix there.
Yeah, so real estate is something that for a period of time now we've been a little bit worried about because of the lagged impacts of rate rises, not necessarily seen in terms of the cap rates that were materializing. And then if you add to that the fact that we've had the sort of regional bank fallout in the United States, that adds to the pressure. That's not something that we saw coming, but that's an example of a crack that could occur. I think it's always important to kind of go a bit more granular, though. One of the things we say when we're building portfolios now, you can't just think about the headline level. You need to be that one level more granular. And in real estate in particular, there is a difference between industrials relative to office space, for instance, right? There are kind of structural dynamics that are changing the nature of how we interact with offices. That's not necessarily the same thing as happening in industrials, where the fundamentals might be a bit more strong on the grounds that effectively e-commerce, the idea of those kind of delivery centers, etc., they are drivers that are going to persist.
Okay, so maybe some opportunity in terms of industrial US real estate. Maybe if you put aside the office space, e-commerce, for example, is one area you could be looking at. Vivek Paul, Senior Portfolio Strategist at BlackRock International, thank you very much indeed for walking through the key market themes and, of course, what to expect from the BOE views as well on the ECB and the Fed, given the CPI print that came in slightly softer than expected. Coming up, US-China relations in focus as the Biden administration appears to offer an olive branch to China. We'll explain. That is next. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise. the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open. We are 23 minutes, almost 24 minutes into the European trading day. A little bit of optimism coming through for European stocks on the back of slightly softer CPI out of the US. Inflation soft out of China as well, putting some to work in terms of betting on additional fiscal stimulus coming through from Beijing. Currently, European benchmark is gaining 0.4%. The FTSE 100 at 7,771 at a gain of 29 points. Futures in the US also pointing higher. The S&P E-minis up 0.2%. To geopolitics now, and Bloomberg has learned that the Biden administration is trying to make it harder for China to say no to engagement by asking for a flurry of meetings and phone calls. It's a strategy aimed at easing tensions. Let's get more then from Bloomberg's China and economy and government editor, Jill Deesis. Jill, what does this say then, the outreach from the Biden administration, about their strategy on China? Is it shifting?
Yes, Tom. So it does seem like the Biden administration is certainly trying to ease tensions here. Now, what we're hearing is that there's been a proposal for a flurry of different meetings for all levels of government between the U.S. and China, trying to get these proposals together to get a bunch of people meeting, whether it's U.S. Trade Representative Catherine Tai, whether it's Defense Secretary Austin. There's all kinds of sort of movement in the work from the Biden side, trying to figure out how we can sort of start to ease some of these tensions. What we've also heard is that this is meant to allay some fears that some of the U.S.'s allies may have in Asia and in Europe about whether or not this relationship is sort of spiraling out of control and ultimately leading to some sort of open conflict. So the Biden administration is certainly trying to tamp down any fears there. Now, of course, this is a very risky proposal. I don't need to remind you that tensions over China are very, very hot right now in Washington, whether it be from Republicans and Democrats. Each of these sides have criticized China quite extensively in recent years. And so that sort of appearance of, whether the Biden administration is giving up some clout by, getting involved in trying to push for this relationship is certainly on people's minds. The other thing, too, is that as of right now, it appears that Beijing hasn't really been all of that receptive to some of these potential exchanges. They've apparently maybe ignored some of the outreach from the defense secretary's team. So we'll have to see what comes out of all of that.
Okay, excellent. Jill Deesis in Hong Kong for a look at that outreach from the US to China. Let's see if they pick up the phone over in Beijing. Let's check in on a couple of individual stocks to look at ING, Allianz and Man Group. ING and Allianz with a picture around share buybacks, both 1.5 billion euros. But the story for ING is a very strong beat when it comes to net income for the quarter, the first quarter, tripling from the previous year-on-year quarter. So a really strong beat in terms of net interest income and lower loan loss provisions than expected, rallying there 2.6%. Allianz coming through with a share buyback of 1.5 billion euros, as I mentioned. And Man Group, change at the top there from September the 1st. Luke Ellis stepping down, being replaced by Robin Rowe. That on September the 1st, the world's largest publicly listed hedge fund. Plenty more coming up. Stay with us. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Moderating inflation, US CPI cools in April, giving the Fed scope to pause rate hikes. Meanwhile, Treasury Secretary Janet Yellen warns on a debt default.
A default is frankly unthinkable. America should never default. It would be tremendously economically and financially damaging.
More hikes in Europe. The Bank of England is set to raise rates for a 12th straight meeting today. The ECB's Joachim Nagel tells Bloomberg the central bank is getting closer to restrictive policy, but isn't there yet. Plus, Jamie Dimon exclusive. We will be speaking with the CEO and chairman of JP Morgan Chase at the bank's annual Global Markets Conference in Paris. A conversation, of course, you do not want to miss. A little bit of optimism coming through European equities on the back of softer inflation out of the US. The first print below 5% in about 2 years. You saw yields on the front end yesterday moving by about 11 basis points lower on the US 2-year. And you see yields coming in between 2 and 3 basis points on German bonds as well, as a little bit of money moves into European debt. Across the benchmark then, gains of 0.5% over in Germany. The DAX adding 48 points. We've been speaking, of course, to the central bank governor of that country and, of course, a board member of the ECB, Joachim Nagel, on the closeness, the proximity to restricted territory for the ECB, but certainly not raising or ruling out further hikes. The FTSE 100 gaining 30 points, up 0.4%. Across your sectors, iron ore is back in focus in terms of the impact on basic resources. That's at the bottom of the list, down a full 1% as a sector. And basic resources, iron ore, I should say, down about 3% the last time I looked. On China and some of their steelmaking capacity, they're cutting prices, slashing prices for iron ore. It's back below $100 for iron ore currently. At top of that is media, currently gaining 1%. Consumer products also in the green, healthcare as well. And some optimism coming through on the earnings front from the likes of ING. A very solid beat in terms of net interest income, really bolstering the balance sheet. And of course, loan loss provisions as well, coming in slightly lower than expected for ING. A beat there. Allianz, by the way, returning cash to shareholders with about 1.5 billion euros of buybacks. Let's get over, though, to JP Morgan's annual Global Markets Conference in the French capital. The event comes just 10 days after the lender took over the troubled US bank First Republic. Let's go over to Francine Lacroix, who joins us live from that conference with a guest. Fran.
Hi,
Hi, Tom. Good morning. I'm delighted to be joined by Franklin Templeton, Chief Executive Officer Jenny Johnson. Jenny, thank you for joining us. There's so much going on in the world. It's not only banking crisis. We talked about U.S. defaults. Are you expecting more banking turmoil ahead?
So, I mean, no, there shouldn't be, right? We should be stabilized. But, what we've seen is banking is a game of confidence, right? And so if there suddenly becomes a wave of people who, via social media, start to say, oh, I'm worried about this, suddenly you do see this withdrawal. I mean, for all purposes, First Republic was a great, stable bank, right? And then suddenly there became this wave of concern. So hopefully that's calmed down and we won't see it. I don't know that we've fully seen the implications of what's happened with some of the regional banks, but I think we shouldn't see too much more.
So, but what do you mean by that? They could go under, they could be takeovers or credit crunch?
Regional banks play a really important role, particularly in like commercial real estate, right? And so, as their need to pull back a little bit and the resetting of some of these rates as debt becomes due or new construction debt is needed, they're not going to be there, I think, at the same level. And if you look at regional banks, community banks, and small banks, they account for 25% of the lending in commercial real estate. So, I think that's one area that we could see some stress going forward.
How much stress? So commercial real estate, again, usually it's longer maturities, or certainly the refinancing is on a longer term.
That's right. I think anybody who's mid-project or trying to get financing, it's definitely going to be tougher. And I think in commercial real estate, it's depends on where you are, right? So I think office is going to have a hard time. I think it's really hard for people to underwrite office. Retail malls, I think, are a little bit more stressed. But, housing is a great market. We've underbuilt, so I think there's a lot of confidence around that. Industrial, that you've seen increased rents there as the demand has continued to be really strong. So I think the important thing is it's going to be where are you? But I think the other side of that is you are going to see some of the lenders pull back a little bit.
Do you worry about private markets? So there's always concern about either liquidity or actually when you just raise rates from the level since, from where we were 12 months ago, something has to break.
Well, so do I worry about private markets? What I'd first say is we have Benefit Street Partners and Alcentra are 82 billion private credit managers. They're saying they haven't seen deals this good since the global financial crisis. So actually, it's a great opportunity if you have the cash to deploy. Secondary private equity, they're buying because there's so little supply in secondary PE and such a need for some of the LPs to actually move off their allocations to private markets because they have future commitments. They're buying deals at private equity at 80 cents on the dollar. They're buying real estate at the high 70s, and venture is below 50%. And it's not a function of the value of the assets. It's a function of supply and demand, with a lot that's been deployed in the primary markets and not enough funds raised in the secondary market.
But are you also expecting the role of private markets to change? So a lot of private equity companies are buying and holding on to assets, and we hadn't seen that 10 years ago.
Sure. I mean, I think that anybody who is in private equity and their business model was more around leverage is going to be tougher. But if your business model was more around restructuring and trying to kind of fix a company and then have it go IPO, I think that's going to still work. I think there is a fundamental shift in that companies are not wanting to go public if they can stay private for longer. I mean, you think about what's going on right now in technology and your need to invest in technology, that if you're just focused on quarterly earnings, you can't make those longer term investments. So if you're private, you can do the restructuring in a way it's harder to do when you're public.
When you look at some of these companies, our industry groups, is there something that looks particularly attractive, or an industry that's... Just industries that look attractive given the transition we're going. So economic transition, but also some of the technological transitions.
Well, so look, we are in the fourth industrial revolution, and so there's going to be really interesting technology companies that, of course, carry us forward. I think healthcare is going to be amazing. I think the way medicine's going to be looked at 20 years from now, we're going to feel like we were, using it with a blunt instrument. I think there's going to be really exciting changes around that.
We're here in Europe. Any opportunities in Europe? Where are you looking I mean, the interest rate environment is similar but slightly different to the U.S.
You know, I think it's always good to go with the trends, right? And so if you look at the types of things that are happening in Europe, a couple of big trends, right? Energy security, I mean, post-Russia, Ukraine, people looked at food security, right? So you're going to see opportunity there. And actually, for the first time, kind of military, right? There's a need to I think there's been a change in attitude. So those are three big trends that you're going to see change in Europe.
But you think there's opportunities in Europe? I know when you speak to a lot of U.S. investors, they kind of think that Europe's about to implode.
I think they have, and you're seeing a little bit of inflation there. So, yes, I think in those categories, there's certainly opportunity in Europe. I think people had sort of not written off Europe, but said, oh, there's opportunity in other places. But no, of course there's opportunity in Europe.
Jen, given everything we've talked about, is there anything that keeps you up at night that you kind of...
AI and ChatGPT.
because we don't know where it ends?
I just think, we're at an inflection point here where think about ChatGPT as being the moment of the internet browser being delivered. So suddenly, AI has been around for a long time. Suddenly people are like, oh, now I get it, right? And anytime there's that comes into a business, you have to think about how you should change your business and how you should leverage it to make sure that you're staying competitive. And so, it's something that we're spending a lot of time thinking about.
Yeah, and the problem, I guess, is that technologically we all have access. So actually the pace of adoption is so much bigger than the browser.
Suddenly everybody is an AI person, right? They're like, oh my gosh, now I get what this means. And so it is we all have to be thinking about how it's going to change our business.
Yeah, do you think it will change our economies as well? I mean, as an investor, is it opportunity to find something, or you just have to look at your portfolio and say, where do we end up in 4 years?
I mean, there's no question. Think about it. It's funny. I ran the e-business world when the internet was first out, and everything at Franklin Templeton that was under internet was under me. I couldn't get the marketing department to pay attention because they didn't want to spend their time on that thing called the internet, right? We're going to be a little bit at that moment where suddenly everybody is saying, I'm not sure what to do with this tool, but I know it's going to be really important. It's going to be important for investment people to be, finding insights and leveraging insights. It's going to be a way to consume information. There's something called Chat PDF, which allows you to, take in an annual report and ask questions in there. So now you can look at many more annual reports and see it. So it's just going to be another way to view information. And, I have ideas about how it can make changes in a company. I know it's going to be significant.
So watch the space.
Jenny,
Jenny, as always, thank you so much. That was, of course, the Franklin Templeton Chief Executive Officer, Jenny Johnson. With that, Tom, I'm going to send it back to you in London, and we'll have plenty more from Paris throughout the day.
Yeah, really interesting conversation, Francine, on the ground for us, of course, at JP Morgan's annual Global Markets Conference in Paris. And the big one coming up, we're going to be speaking to Jamie Dimon, the CEO and chairman, of course, of JP Morgan Chase. That is at 1:15 p.m. UK time. Do not miss that interview. A couple of lines crossing from Nissan, of course, the Japanese automaker, upgrading their forecasts in terms of full-year operating income and profit, well above the estimate. So operating profits expected to come in at 520 billion yen. That is a full 120 billion yen above the average estimate. There's still some question marks for this automaker around margins, getting those back up to where they need to be, the transition, of course, to EVs, particularly in that all-important Chinese market, and whether or not they can get back to full production. They're expecting about 4 million units to be delivered this year. They do actually have production capacity of over 5 million units. But nonetheless, the upgrade in terms of the forecast for operating profit coming in above the estimates for Nissan. That's the year-to-date stock moves, 21% gains for that company. Coming up, no magic. Disney is seeing a wider loss in its streaming business after losing subscribers for 2 straight quarters. More details on that story next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, 45 minutes into the European trading day, and you are getting slightly more conviction around the optimism through these equity markets. 0.6% gain for the European benchmark. You saw the Nasdaq yesterday, tech heavy, of course, getting back to levels last seen in August. 22% year-to-date gains. If you hadn't led into that and lead into that rally, you'd have lost out on that opportunity around the Nasdaq. Does that continue, though? Of course, the rates environment crucial for the tech sector. Here in the UK, the FTSE 100 up 0.6%. That's despite the drag coming through from basic resources. Futures in the US, S&P E-minis currently up 0.3%. Let's get back to the tech story, though. Arguably, Disney is a bit of a tech play. Disney shares falling in extended trading after reporting a drop in subscribers to its streaming service. That's as the US media giant is also predicting a wider loss in that business this quarter. For the details on those second quarter results, let's bring in Bloomberg's tech reporter in Berlin, Aggie Cantrell. Aggie, what do these subscriber losses then mean for Disney? How bad is it for the business?
Yes, Tom. Well, it's interesting that you point to the fact that Disney is essentially sort of a tech company, and we measure it in the same way that we measure other similar outlets, like, for instance, Netflix. The subscriber number and subscriber growth is a key metric in which to assess these companies, and that's also the case with Disney, especially as they are seeing a huge amount of losses when it comes to their linear networks, when it comes to their programming on outlets like ESPN and ABC. That is being sacrificed as people get pushed further and further to streaming platforms. And the loss in subscriber numbers this quarter is a concern. This is the second consecutive decline for subscriber numbers at Disney, and that's a concern for a company that is pivoting towards the streaming platform as its principal source of content. But as well as that, the other thing that that caused a wobble after hours was on the earnings call. They also signaled this 100 million widening projected loss in this quarter as well. So it's not just about the subscriber numbers, but also traditional metrics like the income and the profit for the company.
Yeah, and this, of course, with Bob Iger firmly back in charge, of course, at the top of Disney, and the cost-cutting that's been pushed through that. What does the rest of the year look like then? How much visibility does Disney have at this point?
So that's the big question. We've seen the returning CEO, Bob Iger, say that his focus is on fixing streaming, is on making sure that really means it's about cost cutting. It's about cost cutting to the cost of content and the cost of marketing that content. But then while you're also trying to reshape those costs, you're also going to have to question what that will do to those subscriber numbers. We're seeing them potentially reduce the amount of content on the streaming platforms so that they don't have have those costs incurred, but still trying to attract new subscribers with new content while also trying to make sure that they're marketing their content better. And so really there are lots of open questions for the platform in the next year. And also one that I found interesting was that they say that at the moment they don't really know the extent to which the writers' strike is going to have an impact on the business and the content that they're providing going forward, because they don't know how long that strike is going to last.
It says something about the business, doesn't it, Aggie, that we haven't even talked about theme parks, because you're right, streaming is where it's all at. You talked a bit about movies, but no theme parks. Aggie, are you a fan? Are you a Disney? I don't put you down as a Disney fangirl, but maybe I'm wrong. With the ears, do you have the ears? Do you go to the theme parks?
I can't say I've been to a Disney theme park since I was a child, but to be honest, I also think that there's probably a lot of adults who are still attracted to the theme parks, if Disney adult Twitter has anything to go by.
Very, very diplomatic. They need to win you back, don't they? Clearly, that's what they're missing. Aggie Cantrell, thank you very much indeed, with the earnings coming through from Disney. Let's get the Bloomberg Business Flash now. And today's top stories. UBS Bank is assessing Credit Suisse's business. Well, they flag concerns about some portfolios of loans in high-growth Asian countries. Bloomberg sources say concerns over lending relationships in markets including Indonesia, Vietnam, Malaysia and India could lead to the assets being run off or sold. UBS is said to be weighing options to address the issue after stepping in to rescue Credit Suisse. Both banks declined to comment. Meanwhile, Bloomberg also understands that funds including 463 and Diameter have been buying CDS contracts tied to Credit Suisse debt on notions the write-down of its AT1 notes will trigger a credit event leading to payment. Carl Icahn's investment firm plunged 16% after disclosing a federal inquiry into its practices. Icahn Enterprises says U.S. attorneys are seeking information on governance, securities offerings, and dividends among materials. Separately, the firm hit back in detail for the first time against a report from short seller Hindenburg Research, which claimed the company had inflated valuations for some assets. SoftBank's mobile unit is building a Japanese version of ChatGPT. Wireless operator SoftBank Corp set up a new entity in March, employing about 1,000 people to work on the tech. But the company didn't elaborate on its progress. SoftBank follows a wave of US and Chinese companies in the race to create next-generation AI. That is the Bloomberg Business Flash. Coming up, US Treasury Secretary Janet Yellen issuing a warning at the G7 meeting. We're going to bring you her comments next. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
Happy Thursday, welcome back. We are 53 minutes into the European trading day. Another big day, of course, for the central banks. The BOE expected to hike by 25 basis points. It is risk on across these equity markets. Gains of 0.6% across the European stock 600. Futures in the US also up 0.3. A bit of pressure coming through for the euro, down currently 0.4%. A couple of individual stocks on the move. A really solid set of results coming through from ING, just underscoring what is happening in these European banks in terms of the benefits from higher interest rates and lower loan loss provisions. Allianz, meanwhile, coming through with an additional buyback, share buyback of about 1.5 billion euros. And change at the top for Man Group. We have the first female CEO going to be appointed September the 1st, or at least taking the position, already appointed, taking the position September the 1st, taking over from Luke Ellis will be Robin Grew as the head of the world's largest publicly listed hedge fund. That's Man Group, of course, listed here in the UK. Meanwhile, the concerns about the debt ceiling are gaining prominence. Treasury Secretary Janet Yellen saying that the failure to avoid a looming US debt default would undermine Washington's abilities to provide international leadership. Joining us for more is John Herskovits, Bloomberg's East Asia government reporter in Tokyo. John, what were your key takeaways then from what we heard from Janet Yellen and her warning?
Yellen is facing a number of difficult situations right now. We have the debt ceiling, which they're trying to get done in just a matter of days. And Yellen really put a great deal of emphasis on tightening the sanctions on Russia for its full-scale invasion of Ukraine. She's looking at mechanisms to get partners involved, to increase surveillance, and to go after dual-use goods, perhaps provided by third countries. But this comes at a time when China's foreign minister was just in Europe, saying that China is willing to react strictly and strongly to any measures which might punish Chinese companies in all of this. So we have that going on. We have the G7 leaders meeting coming up later this month in Hiroshima. And what the leaders see as economic coercion by China is going to be one of the issues that will be front and center when they get together to discuss their main concerns.
Okay, John Herskovits in Tokyo for us on the speech coming through from Janet Yellen. The focus, of course, on Russia, China, and that debt default ceiling. To what extent that actually overshadows and undermines the US attempts on both China and Russia is going to be an interesting question as well. We're going to be speaking, by the way, to the Treasury Secretary tomorrow. That's going to be an exclusive interview for Bloomberg, so tune in for that. That is it for the European market open. Optimism across these European markets, stock markets, at least for now, on the back of that slightly softer inflation print coming out of the US. Maybe some betting as well that maybe China can up the stimulus, given that inflation remains very subdued there as well. Surveillance Early Edition is up next. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Francine this half hour. Here's what's coming up on today's program. Moderating inflation, U.S. CPI cools in April, giving the Fed scope to pause rate hikes. Meanwhile, Treasury Secretary Janet Yellen warns a debt default would spark a global downturn.
Default is frankly unthinkable. America should never default. It would be tremendously economically and financially damaging.
More hikes in Europe. The Bank of England is set to raise rate for a 12th straight meeting today. The ECB's Joachim Nagel tells Bloomberg the central bank is getting closer to restrictive policy, but isn't there yet.
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down.
The ECB's consumer inflation report is hitting the tape now, feeding into those comments from Nagel. The ECB saying that consumer inflation expectations rose significantly. This is for the month of March. They are seeing higher inflation expectations than they did the month before, than they did in February. Yes, this is backwards looking, but it is reigniting this fear of entrenched inflation in Europe. Is the ECB going to have to keep hiking? We'll take a look and see in a bit whether that's moving bond markets. We also just minutes ago got Emirates Group earnings crossing. Reminder, this is not just the airline, it is the bigger company. Profit, 10.9 billion dirhams. They're going to pay a dividend of 4.5 billion to the owner ICD. These are very strong numbers, represents a significant turnaround for the group. So that's some of the earnings. That's the big picture. It is inflation on the mind of everyone. Are we going to see this divergence between the U.S. and Europe? Not just the U.S., by the way, China too. Inflation not picking up. We thought this would be a big source of inflationary pressures throughout the globe. It's not playing out. Now, part of that is giving a boost to equities today. Yesterday's strong session in the U.S. Let me show you what we're seeing in Europe so far. European stocks up 0.5%, more than 0.5%, I should say. It is a session of buying for bonds, 10-year yields, those lower by 1.5 basis points. I did want to point out just how strange this curve is. Basically, the whole curve is moving lower, except for the very front end. Why is that? We're pricing in this risk of a default. It's not hugely priced in. Bloomberg MLI pointing out that it's only about 3%. Even so, the most inverted we've seen in 1 month 10-year yield curve since at least the 2000s, since we have data going back. Copper LME, I just want to point this out because, again, it's that China story. The growth there, the strength, not as strong as we thought it would be. Producer prices, those disappointing, those fell. So copper taking another leg lower over that concern about global growth, down 1.5%. Now, just to show you the overall European picture, most regions are higher today. Maybe a little bit of lagging from the DAX. That's only up just less than 0.3%. We had some earnings today. Bayer, ThyssenKrupp, a lot of big German companies which weren't as strong as many had hoped. CAC 40, that's doing well, up 0.8%, up 0.5% for UK stocks too. Now, we also heard from Treasury Secretary Janet Yellen early this morning saying that a U.S. government default would undermine Washington's ability to provide international leadership. She was speaking at the G7 summit in Japan and called such a scenario unthinkable.
A default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced, American businesses would see credit markets deteriorate, and millions of American families that receive government payments would likely be left without the resources that they were promised.
Don't miss our exclusive conversation with Janet Yellen. That will be tomorrow morning at 8:30 a.m. UK time. Now, the other big piece of U.S. news, inflation showed signs of cooling in April, opening the door for the Fed to pause rate hikes soon. CPI rose by 4.9% from a year earlier, making the first sub-5% reading in 2 years. Joining me here on set is Christine Aquino, managing editor of Bloomberg Markets Today. It does feel like the sigh of relief, Christine. I mean, if we're getting this CPI reading, it's hard to see what could really happen to really change the picture, say, for perhaps a U.S. default before the next Fed decision.
Yeah, that's it, Danny. I mean, obviously, lots of worries growing now over potential U.S. debt default, but at least inflation is giving markets some relief here. And yeah, I think that number really cooled a lot of expectations that may still be out there for the Fed to keep going after this month, potentially. But I think it really just affirms the latest message that we got from Fed Jay Powell himself, saying that they are potentially ready for a pause here. And if you look at the components as well, quite interesting. A lot of them kind of the transitory sort of inflation, right? It's gasoline prices, and I think a little bit of the used car prices making a bit of a comeback. I mean, these are things that are kind of more seasonal. It's probably happening because we're ahead of the summer driving season in the U.S. But all in all, looking a little bit less sticky and some relief.
Are we going to start talking about immaculate disinflation again? Because the labor market is still really strong. I mean, it goes back to this thing of, is the Fed's job truly done if we're still seeing things like wage pressure?
Yeah, I mean, that is the big question, isn't it? And if you just kind of look at the core measure, I think it would be hard-pressed to say that the Fed is truly done, right? Because even that's kind of the flip side of the inflation number, is that core has remained in that range of 5.5 to 5.7% since December. And so that really hasn't budged at all. And I think this really just drives home the message as well, that the easy part of the Fed's job in reining in inflation is behind us. It was kind of getting it from near double digits to where it is now. That's really the easy part, you know. It's now kind of bringing it back down to that 2% target, which is looking really quite far away by the day.
Yeah, and it's like, do we have to have a hard landing in order to get to 2%? Christine, always such a pleasure to start the show with you. Christine Aquino there, a managing editor of Bloomberg Markets Today. Now, contributing to perhaps some slower global inflation, China's consumer inflation slowed to the weakest pace in 2 years in April, while producer prices fell further into deflation. Joining us now is Bloomberg's Jill Desis in Hong Kong. Jill, what happened? Because it was not that long ago that everybody was talking about the fact we get this global inflationary pressure coming from China reopening. I mean, that's not playing out.
No, it's really not, Danny. I think that what you're looking at here is, perhaps some more trouble signs for the economic recovery. I mean, at this point, look, economists were thinking that there was going to be a drop-off, a slowdown in inflation in China. I think 0.3% around was the estimate. I mean, we almost fell into deflationary territory with consumer inflation in April. You're looking at maybe some additional pressures, some slowing domestic demand that I think is sort of calls into question even further the state of the domestic, economic recovery here. And it also, look, there's been so many signs recently with a bunch of other points of economic data that have been somewhat troublesome. Manufacturing activities falling off in April. We also saw a drop off in imports, a slowdown in export growth. And also, I'm just looking now, there's a headline that just crossed the terminal about credit expansion in April. It looks like we're still getting some of that data, but ultimately that's coming in quite a bit weaker than some estimates. So ultimately, all of this is sort of forming the picture that the economic recovery in China right now, maybe there's some questions about sustainability, and we're going to have to see whether that continues into May and then June.
Maybe kind of a piece of good news for Europe and the U.S. who are still trying to fight inflation. Jill, thank you so much. That's Bloomberg's Jill Desis in Hong Kong. Speaking of fighting inflation, coming up on the program, sticky inflation is fueling bets. The Bank of England will raise rates again. We're going to discuss that with Martin Wheely, former BOE MPC member. And we're also going to hear from the man himself, the BOE Governor Andrew Bailey. That will take place at 4 p.m. London time. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. It's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, Bloomberg continues its coverage of the J.P. Morgan Global Markets Conference in Paris with an exclusive interview with J.P. Morgan CEO Jamie Dimon in the wake of the bank's purchase of First Republic. Join Francine Lacqua at 8:15 a.m. Eastern as they discuss the banking crisis, taming inflation, jobs, and more. It's all happening live on Bloomberg Television and Radio, your global business authority.
First of all, it was important that we hiked rates last week. I think it confirmed our commitment that our monetary policy path is not over to fight against inflation. Inflation is still very sticky. It is a very stubborn phenomenon. And as I said several times, you have to be even more stubborn. That means for me that story about hiking rates is not over. We have to do more. So there are 2 more meetings before the summer break, and let's go.
So you said that it was likely in the home stretch, whereas Christine Lagarde has talked about there's still more ground to cover. And inflation has been stubborn, and core inflation has been stubborn in Europe, and it's seen picking up in places like Italy. So 2 more possible hikes by July. What about September? Is that off the table or definitely a possibility?
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
Mm-hmm. How long would if they pause in July, how long a pause would you anticipate? I think the longest time that they would stay at that peak has been seven months or so. Would you see that as a good benchmark?
So again, I do not know where we have to stop, but when there's the point coming that we could more or less stop the rate hikes, then I have to believe we have to stay there for a while to wait what is the impact, what we did from the past, to see are we really successful or not, and this is very important.
Well, how long of a sustained drop, if you will, in core CPI would be enough?
I think what I see in the numbers is that it will take at least 1.5 years till we see numbers that are close to our target. So we have to be patient here.
I know Barclays was predicting a pause and a pause until the second half of 2024 and then hikes. Is that something that would be feasible, or is that too far to predict what the data might say?
This is maybe would be also speculation. So what I see is that we have to wait for the incoming data, and then we will decide. So this meeting-to-meeting approach, this is the right way to do monetary policy in these days.
Bundesbank president and ECB governing council member Joachim Nagel there speaking exclusively with Bloomberg's Stephen Engel. So if that's the view from the ECB, here in the UK, there's stubborn double-digit inflation, which is set to force the Bank of England into a 12th straight interest rate hike today, even though the end of its lightning-quick hiking cycle is coming into view. Let's get over to UK correspondent Lizzie Burton, who's outside the Bank of England with a special guest. Lizzie.
Thanks, Danny. Well, as you say, a quarter-point hike from the Bank of England's looking pretty nailed on today. Markets and economists in agreement, but where they don't agree is what is the future path for rates. Well, joining me now to discuss is Martin Wheel, Professor of Economics at King's Business School. Martin, thanks for being back on Bloomberg TV.
Hello.
You are a former member of the Bank of England's Monetary Policy Committee. Do you think that a quarter-point hike today should be the bank's last?
I really don't know. I mean, the bank on occasion has tried to give guidance about where interest rates go. I voted against forward guidance in August 2013, and when it became clear the policy had failed 6 months later, the MPC produced a statement which said that the actual interest rate would depend on the actual state of the economy, and that's really all the MPC can say or should say.
But they should hike again today.
I certainly think if I were on the committee, I'd be voting for an increase again today, yes.
You're also an honorary fellow at NISA, the think tank. It says that inflation won't be halved by year end, which of course is the Prime Minister's #1 target. Do you agree with that?
Well, I think there's a real risk. We've seen inflation being more persistent than had been expected even 3 or 4 months ago, and particularly with the high level of food price inflation, that's the sort of thing that is likely to sustain pressure in the labour market, and that in turn means that businesses are likely to be having to put up their prices. So whether things will turn out as the National Institute has forecast, I don't know, but certainly there is a real risk that Sunak's inflation target won't be met, and I actually think he would have done better to leave discussions of inflation to the Bank of England.
And you mentioned forward guidance, but on the Bank of England's comms in general, the chief economist got in some hot water for saying that Britain should accept they're poorer. Was he right to do that?
Well, the reality is that the country is poorer. People focus on GDP, but actually a much better indicator of living standards is what's happening to national income, and that has fallen fairly sharply because of the increase in gas prices.
And on fiscal policy, there is lots of calls for the Chancellor, Jeremy Hunt, to cut taxes before the next election. Is that a good idea?
Well, my view is that the national debt is high. We seem over the last 20 or 30 years to have lived in a situation where it goes up when something unpleasant happens and doesn't go down, in more normal circumstances. So all that tells you is that the national debt is going to rise indefinitely, and I think that's a signal that cutting taxes now would give.
And one of the reasons that we've got double-digit inflation in the UK is, of course, the tight labour market. Has the government done enough to plug the holes in the labour market?
Well, the government has done something. We have to see how much effect it will have. It's true immigration has been higher than was expected, but I think we are still suffering first from the effects of Brexit and the limits that's placed on immigration from the rest of Europe. And secondly, we're suffering from the people who've dropped out of the labour market in the aftermath of the epidemic. Maybe they will decide to go back to work as they discover that their pension savings don't last as long as they'd hoped. I don't know.
And of course, we'll soon get more jobs data. Are we underestimating the price-wage spiral in the UK?
Well, I think we have seen a price-wage spiral. It's perfectly true that wages haven't been going up as much as prices have, but I think most people would say that the reason that private sector regular pay is growing at about 7% is because inflation has been so high over the last year and a half or so.
All right, Martin Wheel, Professor of Economics at King's Business School, thank you very much for joining me. Back to you, Danny.
Lizzie, fantastic interview, a good setup for a few hours' time when we get the BOE decision. Bloomberg's UK correspondent there, Lizzie Burden. And of course, we're going to be bringing you that decision 12 p.m. today, and special coverage of the news conference. And Bloomberg's Guy Johnson will be sitting down with BOE Governor Andrew Bailey. We're going to bring you that interview today, 4 p.m. London time. But first, coming up on this program, no magic. Disney is seeing a wider loss in its streaming business after losing subscribers for 2 straight quarters. We'll have more on their outlook next. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg.
From the world of politics to the world of business, Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Disney shares are down in the pre-market trade after reporting a drop in subscribers to its streaming service. This is also happening as the U.S. media giant predicts a wider loss in that business this quarter. Joining us now for more is Bloomberg's Alex Webb. So we're down, nearly 5% in the pre-market. What do these subscriber losses mean for just such a giant like Disney?
There'd often been a conversation about what is the base layer when it comes to streaming. That ultimately, that's what people thought Netflix was. So you'd have Netflix, and then you would add other things on top of that. That thesis started to fall apart a little bit. But this does start to make it look as though Disney is very much a discretionary piece, that actually Disney Plus isn't the streaming service that everybody feels they need. It's something that, you know, if you like Star Wars or Marvel, perhaps, and kids' films, then you might get it now. There are a lot of people that do like those three pools, but it's not everyone, and not necessarily everybody feels like they need them. Also, some of the new content coming onto Disney Plus hasn't been quite as exciting as the first flush that we saw. That seems to have taken some of the wind out when it's compounded by the economic circumstances.
So given that, I mean, how much visibility do they have going forward? Because as you say, the economic circumstances, I mean, there's just still so much unknown at this point.
Well, they telegraphed that in this quarter there's going to be $100 million, worse hit to their earnings as a consequence of marketing spend, which presumably is an effort to bring some of these subscribers back. There are renewed efforts now. He said Bob Iger, the CEO, said he's going to try to integrate Hulu, which is technically a sort of joint venture. It's 75% Disney, 25% Comcast, the parent of NBC Universal.
Right.
Disney has a right to buy that at a particular price. It increasingly looks like that is going to happen because he says he's going to try to merge Hulu into Disney+.
Oh, that's interesting because Hulu is maybe less discretionary. I mean, I remember when I lived in the U.S., like Hulu was a must to have to watch all the shows I wanted to.
But the thing that's interesting, actually, if you're here in our part of the world, if you get Disney+, all the shows that are on Hulu in the US are on Disney Plus in Europe, right? And so it already is the case in the rest of the world. It's really only in the US's home market. Think about it. You get Handmaid's Tale on Disney Plus in Europe. In the US, you have to have Hulu and Disney Plus if you want to watch Handmaid's Tale and The Mandalorian, for instance.
Right.
So it's bringing more, it would be in the US, bringing more sort of grown-up content, as it were, onto the main Disney Plus platform.
Alex, thank you so much for that. That's Bloomberg's Alex Webb on Disney earnings. Now, coming up later, Francine is going to be sitting down with JP Morgan Chase Chair and CEO Jamie Dimon. Stay with us for that. Plenty more interviews ahead. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in Paris with a special focus this week on finance in the UK and Europe. Now, over the next half an hour, we're here in the French capital. It's increasingly in the corporate spotlight after Brexit, and I'm here for JP Morgan's Global Markets Conference. So we'll have plenty of interviews, and of course, we'll look at the markets. Later, we'll bring you our exclusive interview with the bank's Chief Executive Officer, Jamie Dimon. That's at 1:15 p.m. London time, and then a little bit after that, back in the UK, of course, we know it's decision day from the Bank of England. They're expected to raise rates another time, and we'll bring you our interview with the Governor, Andrew Bailey, later today, and that's at 4 p.m. London time. But let's start with a catch-up on the markets. Let's begin with Mark Vajrachani, JP Morgan Securities Head of Global Sales and Research. Mark, as always, thank you so much for coming on. Markets are all over the place. We have investors, we have a lot of analysts saying, look, a recession is near. The credit crunch is arriving. People are hiring less, and yet the markets are range-bound. What's your feeling?
You're absolutely right. First, welcome to Paris, Francine. You know the city well. We had you last year. We have you this year. We have more than 1,000 people this year. I think, for the first time, people are coming back from Asia. Like last year with COVID, they were not. So, with that said, as you said, and you have Jamie later on, you look at all the bad news out there, and there are plenty. You have debt ceiling in the U.S. You have regional banks, you have inflation, you have the Bank of England later today. So you have many reasons, and our clients are telling us we have many reasons to be negative. Having said that, every day that goes by, the market goes a bit higher. So the question is, what do people really think? They think there is recession and should go lower. What is happening is probably not exactly the same.
So I don't really understand market behavior. Is it because people are still fully invested? Is it because of the private markets and the fact that there's still no real alternative? Or is it really that...
It's a great question. And if you remember last year, we talked about what people were thinking about commodities. Yeah. And I made the point making the difference between what people think and what people express in their investment. So we had a survey this morning at the conference. A lot of people are still invested in cash. A lot of people see, when you look at the fixed income markets, rates and commodities to a certain extent, they're pricing a recession. Equities is not. Now, I went to Middle East a few weeks ago. I went to Latin America, between New York and London. Everybody thinks the same. Equity markets are too high.
But no one does anything about it.
No, but then you have to ask yourself, the question is, do they think they're too high because they would like to invest more? Or do they think they're too high because if you look at rationally and objectively at all the risk out there, they are too high?
What is the chance of the mother of all crash coming in our face, given all these idiosyncrasies?
That's the million-dollar question. If you're the glass half-empty person, you look at all these things happening around the world, and you think something is going to crack. And the second question that our clients ask us is, what are we not seeing? Is it commercial real estate? Is it the debt ceiling? Is it something else that is more systemic in the market? Today, we don't see anything systemic. That doesn't mean we're right. Then you have the glass half empty, a half full version, which is say, we have a war. We had the biggest energy crisis in the world. We have tension between Russia and China. We had the biggest pandemic, yet the global economy is doing well. So
what are your clients saying? Because you also look at the debt ceiling, and we were, last night being briefed by your head of research, Joyce Chang, on the U.S. default potential that not many people understand. Certainly the market at the moment seems to be ignoring it.
So clients are worried, and clients are afraid the level of conviction is relatively low. So yesterday we had a roundtable with credit investors. The two biggest themes, debt ceiling and regional banks in the U.S. If you had the similar dinner in the U.S., people would talk still debt ceiling would be one. They would have a much more negative view about Europe from the U.S. than in Europe. You look at Paris, you walk around, like, A, people now speak English in restaurants, and B, restaurants are full.
And less rude sometimes?
Less rude, absolutely, yeah.
And so what does that mean? I don't know whether we look at a world where everything's a bit more fragmented, or whether there's just a misunderstanding between the regions which create opportunities.
I think the one thing that has changed compared with the past is that central banks are much more quick in acting. So every time you have a bump in the road, whether it was LDI in the UK or the regional banks in the US, the central banks are very quick to act, sometimes quite impactfully, always impactfully, but sometimes very forcefully. And therefore, you could imagine a scenario where, unlike what we had pre-08, where we were like boom and bust, you could have scenarios where every time there is a little adjustment, you have an adjustment on the market. Having said all that, I do believe today there is a bit of a decorrelation between the fixed income market and the equity market. So something has to give and something have to adjust.
Do you worry that central banks were too quick to act, or if not quick, too forceful to act, so that there's a lag in monetary policy?
It's very easy to criticize the central banks ex ante. The reality is, it's a very complicated work. Were they too slow to act on inflation? Looking back, absolutely. Should they have done more? But if you're the Fed today, it's a very fine balance between fighting inflation and until what level will you be ready to accept? If inflation were to settle at 3%, is that acceptable or not? And not hurting the financial system, especially with the regional banks. So for them, finding that equilibrium is probably very difficult.
And again, inflation, understand. So we focus a lot on what central banks do without really understanding what inflation will do. So we're looking at the problem, right?
But you see, when you talk to clients, they're probably less concerned about inflation today than they were, say, 6 months ago, because they've seen a decline in inflation. The UK probably, yes, it's still sticky, it's still at a high level, but from an investor point of view, they say, okay, we're on the right trend. Okay, then now, as we know, inflation, and it was funny, spending time in Brazil and Mexico, when you speak to clients, say, no, you guys don't understand what inflation is. It will take a while. And they're right, okay? And probably in the West, in the US and in Europe, we're hopeful that inflation will go down quicker than it really is. But it's on the right track, and therefore you have reasons to be optimistic there.
So we also spoke to a number of big investors in France over the last couple of days. Is refinancing a problem? I know we always talk about commercial real estate, but the fact that interest rates have gone up so much, how much stress in certain parts of the market is there going to be?
There will be stress in the market. So one area that people are very focused on is commercial real estate. But then once you unpeel the onion, in commercial real estate, you have office and you have the rest. You could say, well, office is very challenged, especially with working from home model. The reality is, if you have an office in San Francisco, yes, that's very challenged. If you have the same office space or newer office space in Miami, you're okay. You're oversubscribed. So even there, it's very hard to distinguish the two. The other thing is, it will take time. It's not like you have a wall of refinancing overnight. All these things happen over time, and you have deep pockets sitting on the sideline, like PE firms and sponsors who probably see it as an opportunity.
So the last time I spoke to you, there were a number other challenges.
Yes.
Are you a glass half full kind of guy? Because actually, so we saw the banks, JP Morgan played a role in this with First Republic. There was, of course, ETFs, there's Credit Suisse, but overall, the system has held.
The system has held. And overall, if you see like Credit Suisse getting bought by UBS, a few regional banks going under in the US, despite all that, the system is functioning well. And even when we look at what happened last year, you had like S&P going down quite a bit, and in a relatively orderly way. And every time you had a bump in the road, I think between the market players and the central bank, it ended up in a good way. So I am a glass half full guy, especially when I travel. I think it's kind of, and if you haven't been lately, go to the Middle East, you're like, that's probably the high end in terms of how positive you can feel. But even in countries without China, yes, but even with, yes, not all of them, and even with oil coming down, I think you, like, the word is, and again, as I told you, biggest pandemic, you have a war, you have tension between US and China, you have the debt ceiling. Despite all that, the global economy is growing.
Mark, it's also a decision day for the Bank of England. What do you do with the UK? I don't know whether, there's a strong inflation. I think there's...
So stronger, like inflation is probably more challenging in the UK because you have a combination of everything that's happening in the world and Brexit and transition. And you had a change of governments. I think our house view is they hiked by 25 basis points, split vote 7-2, probably another hike in June. We'll see. It's kind of like we're confident. We see like you look at London, it's vibrant. There's still things happening. So it probably take a bit longer, but they will get there.
Do clients ask you about the UK or
less so? So if you're here on the continent, people are probably less focused on the UK. In the US, they would. In the Middle East, they absolutely do. And London remains the number one finance place in Europe. So I think that's where it's happening. Now, Paris is a big hub for us. We have 800 people. We have to have that. We have to service our clients. But it's kind of, and we work well between the two.
Are we underestimating actually a lot of the geopolitics with China?
Yes, and I'm sure you'll discuss that with Jamie tonight. That's the biggest concern for our clients. So today, when we did the poll, number one biggest concern was geopolitics, especially since when you look at it, you have tension escalating between the US and China, almost by accident more than by design, until you had the Biden-Xi summit. I think things have escalated. From what we hear, from what we see, what our clients believe is like, that's definitely the biggest risk out there. And clearly people would like to see a resolution on Ukraine.
Yeah, and it's difficult to trade, actually. Geopolitics, the problem is that traditionally...
Almost impossible to trade.
It's impossible. So
we had a question on China, if people were investing in China, wanted to invest more. And if you look at the answers, it goes from uninvestable to I'm underweight, I need to increase my exposure.
Mark, thank you so much, as always, for joining us. Mark Badruchani there, the JP Morgan Securities Head of Global Sales and Research. Now, we'll have plenty more from here throughout the day. Coming up, Paris reaps Brexit benefits as it seeks to take London's limelight as Europe's biggest finance hub. So we discuss that next with our Lionel Laurent. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
When you U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I would definitely think that Paris is probably the best positioned city and France country in establishing the new continental financial services hub, definitely from an asset management perspective.
We invested quite a lot in Europe, and we decided to establish ourselves and trading hub in Paris.
Brexit has been, in my view, an accelerator. But the reason why Paris is so well positioned now, it dates probably 10 years, 20 years back.
We worked on the legal framework, on the fiscal framework, so that it could be a place to attract new investments. And we have seen the effect concretely. So more and more banks or financial institutions are joining Paris.
The strike, is not unique to Paris or France. I think we had waves of strike across Europe. I don't think strike will obviously put at risk any investors going forward.
There's clearly the bad image, but then the real substance is the infrastructure and the ecosystem that has been built over time.
It's a very diverse in terms of financial services that come into play in Paris. And I think what is important is we continue to see investments in Paris and investors growing there.
Business leaders there on how Brexit has actually benefited Paris. Now, joining us now, Bloomberg opinion columnist Lionel Laurent. Lionel, first of all, it's very exciting because I think it's this week that you launch a Paris edition of a newsletter, and so you'll be focused on finance and trying to figure out really how France is benefiting from Brexit. So we're here, JP Morgan does a conference here, a lot of the other banks. How much has it benefited?
Hugely. Paris has had obviously jobs and capital coming from London. Brexit was the big starting point because US global banks had to have a base on the continent. What's fascinating, though, is that Brexit is only part of the story. Obviously, Macron had pro-business reforms that made France a better place to do business. But also COVID changed the game immensely because remote work and having local hubs started to make business sense for the banks, and Europe was more integrated after COVID. So it's a lot of catalysts, with Brexit being the biggest.
But, Lionel, I guess the question is, what kind of numbers are we looking at? So, of course, if you have to service your clients, and if you have some top earners that you want to keep happy and they don't want to go to Frankfurt or they don't want to go to Amsterdam and they want to come to Paris, you keep them here. But does it make business sense hiring here, because it's so difficult to then restructure, for example, the organization or the union if something were to happen?
I think the direction of travel is just unmistakable, because I think now we're seeing a model where bankers want to be face-to-face with their clients on the continent, and they are happy with checking with their colleagues via Zoom, remotely, or other ways. I think the model has changed. I think that's not going back, because transport costs, inflation have gone up. The European talent pool is now accessible really only from Europe. So I think local models today make more sense for banks, even if overall they would not have wanted Brexit to happen. They like efficiency.
So how does Paris, have an advantage over Frankfurt or other financial hubs in Europe?
I think Paris has the advantage of being centralized. It has big mega cap companies. It has the biggest banks in Europe. It has obviously culture and schools. Basically, it's a place where bankers actually want to live and work, as opposed to the place where they feel they have to go just to keep their job.
At the same time, Lionel, you've been writing some great columns, of course, on some of the strengths of some of the French banks. Again, they've been outperforming some of the rest of Europe. What are the French banks getting right compared to the Italians or the Germans?
Well, I think overall, Europe is economically doing better than anyone thought after COVID and after the energy crisis and the Ukraine war. I think what's happening now is we need to see that continue. We need to see the real economy. I mean, if Paris has to benefit more, the French economy has to keep growing. And that's the challenge, really, for the outlook. You know, can Macron keep reforming and keep investing? That's the big question.
Yeah, and we saw, frankly, Paris burning. We saw a lot of the reforms with people on the streets, a lot of public anger. Does that influence, you know, bankers wanting to live here? And does it make companies think twice about creating a larger hub here?
Well, you know France, I know France. Pension reform is tough everywhere. We're seeing strikes everywhere. I think that is seen as a temporary thing because fundamentally, income inequality is relatively low in France. Inflation looks better in France than even in the UK. I think the question is, all of this depends on French debt and French government support. How is that going to continue if debt is being stretched as a proportion of GDP and if Macron is politically constrained? So that's the issue for the future.
But how difficult is it actually for President Macron? Because I remember his famous speech saying, look, we're going to roll out the red carpet for entrepreneurs, but also some of the bankers. How difficult is it, as a former hedge fund guy himself, is it to help finance, you know, come to Paris whilst dealing with this huge, you know, social unrest and cost of living crisis?
I think it's difficult, but the political story and the economic story are diverging in France. Politically, no question, there's gridlock in France. Macron has a huge uphill struggle to get his reforms through. But economically, you just have to admit that France is not doing too badly relative to other countries. That's part of why bankers stay here and think there's a reason to stay here. It's not just Macron rolling out the red carpet, it's the rest of the economy.
So, I'm excited about your newsletter. I think it comes out tomorrow for the first time. What time?
So it's coming out Saturday. We're doing a kind of weekend takeover of the Brussels edition. No, we work 24/7 at Bloomberg, even in Paris. We're going to take over the Brussels edition newsletter, and it's going to be a weekly roundup of everything you need to know from the ground, local knowledge, but with a global perspective, news, views, markets, finance, economics, luxury, the whole gamut from Paris, but for a global readership.
Great. I'm going to subscribe. You subscribe, right? You go online. You log in and subscribe. Yes. There you go. Lionel, thank you so much for joining us. Lionel Laurent from Bloomberg Opinion, and now newly minted newsletter in charge as well. Coming up, we'll discuss what the future holds for London after a barrage of criticism from some city leaders. We'll have a full roundup of that criticism and those critics next. This is Bloomberg.
Critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
JP Morgan's top executive in Europe says Brexit has cannibalized London's listing pool. Now, data compiled by Bloomberg actually shows listings in the English capital have raised just $18 million so far this year. That's less than 1% of Europe's total. Now, Will Shaw from our finance team joins us now. Will, what does the future then look like for London? And good morning.
Good morning. So I think the first thing to say is that London remains by far the biggest financial centre in Europe still, as a major caveat, and that's in terms of staff numbers, assets and volumes of business. However, like you say, there are signs of trouble at the mill in terms of listings and equity capital markets. There are a few different reasons for that. Particularly geopolitical reasons. You know, as we know, Russian listings have dried up. China tends to be more domestically focused. But whenever you're talking about the UK, you obviously have to factor in Brexit. And as Viz Raghavan, who's JP Morgan's chief executive for Europe, the Middle East and Africa, was saying on this programme a few days ago, Brexit has effectively cannibalised the London listing pool.
Yeah. So, well, I guess the question is, there are many firms that could have IPO'd in London who basically said, no thanks. I mean, what's the step forward?
So I think the big one here to look at is Revolut as a bellwether for what's going on. Now, their co-founders gave a very outspoken interview to The Times just a few days ago. They said they had no intention of listing on the London Stock Exchange. They had a laundry list of problems that they pointed to. They said the regulatory environment was unclear, which made things uncompetitive completely, particularly when compared with the United States. They talked about red tape, about high taxes, and a skills shortage from Brexit. So generally, you know, there is a sense of pessimism around listings in the UK. Again, I'd come back to that caveat. You know, a lot of the talk at the moment is about Paris, about how well France is doing. The UK remains like very dominant in terms of financial services.
Will, thanks so much. Will Shaw there from our finance team. Now, don't forget also to listen to our podcast, and you can subscribe to In the City as well. It's the one I host with David Merritt, and you can find Apple Podcast, Spotify, or wherever you get your podcasts. New episodes drop every Thursday, and today we talk about some of the CBI scandals. A reminder, BOE decision, that's at 12 p.m. London time, and then we have a special interview with the governor. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Trade-off of kind of stabilizing inflation, stabilizing growth is so hard for developed markets the world over, but it's almost particularly for the Bank of England.
Quite a significant amount of tightening has been done since the cycle began. Rates are in restrictive territory, and we know that monetary policy acts with lags, so potentially the real effect of these hikes is still to come.
If we are cutting rates in the UK, it's probably because something's gone wrong.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. G7 nations will announce a joint effort to counter what they see as economic coercion by China. Meanwhile, Treasury Secretary Janet Yellen fires another warning, saying the debt default would hurt U.S. international leadership. The Bank of England comes out today with another decision on interest rates. Economists expect a 0.25 percentage point hike. And shares of Disney are lower. The world's largest entertainment company posted a drop in subscribers to its streaming service and warns there will be a wider loss this quarter. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And a lot of focus on the Bank of England, of course, where I am. Kriti, more globally, we see risk aversion perhaps in FX markets, but not in stocks. Stocks seem to be higher.
They do, but look, it's coming on the background of about 2 days where we are lower in the stock market. So you are seeing a little bit of perhaps a reversal showing up in today's session. But the question is, what is driving it? Is it the macro or is it the micro? A lot of eyes, Anna, on that BOE decision, like you just said. And it actually does have consequences for what we're going to hear stateside, specifically in the FX market. But remember, even the FX market has ripple effects into the stock market. Let's start from the top bottom. S&P futures higher by 0.3%. But again, this is not something that I would call major conviction or major momentum. Anything can change as we we see the BOE potentially issue further warnings or talk about further rate hikes, because that's going to have a ripple effect on the U.S. bond market, which brings me to our 2-year yield, 393, sustainably below that 4% level. But look, we are still hovering around there. So technicals really driving the bond market in the absence of a more sustainable catalyst, like some sort of solution to the debt ceiling debate. That meeting coming tomorrow, of course, higher by 2 basis points at the moment on the front end of the curve. As we see a little bit of a bump up in the bond market in terms of yields, the dollar takes its cue from there as well, higher by 0.3%. Perhaps a defensive trade on the surface, but again, if the BOE comes out far more hawkish than expected, that's a trade that could disappear very, very quickly. A weaker dollar could then eventually lead to potentially more stock market gains. So Anna, really a story of the domino effect today. And of course, NYMEX crude 73 handle, really following the risk sentiment. Again, you are seeing in the stock market higher by 1.2%.
Yeah, and here in Europe, this is the picture across those stocks then, Chrissy, and we do have positivity here, up by just 0.2% in London, much more though in Paris, up by 0.6% or so. And if I show you what's going on with the consumer-facing sectors, we're risk on in that sense. So the sector breakdown shows that nearly all sectors in Europe are in positive territory. Consumer products and services is one of the best performing today, up by more than 1%. So the likes of Puma and Adidas, the sportswear manufacturers, but also luxury goods companies, all of those trade a little stronger today. Change at the top of Man Group is coming. The CEO is going to be retiring. Luke Ellis, someone we've spoken to on this network many, many times. He's going to be leaving the business, and the current president is going to be stepping into the role. The first female boss for this business, the first time a woman in charge in hundreds of years of history for the world's largest listed hedge fund. So that is in focus, not stock moving, but worth noting anyway. And this is the FX markets. Chrissy, you were just talking there about the dollar strength, and it does seem to be that the dollar is in the driving seat here, because we have weakness in both the euro and in the pound. Both of those could be driven by news flow domestically, but perhaps not so much just yet. The pound, of course, we wait for the Bank of England. We're at 125.90 as we wait to get that probably 12th increase in a row. More details on that in a moment. The euro is at 109.34. We are down 0.4% there. Interesting in the face of what seem to be slightly more hawkish comments coming through from Joachim Nagel at the Bundesbank, who's been speaking exclusively to Bloomberg at the G7 meetings. We'll play you some of that shortly, Chrissy.
Yeah, and of course, as we talk about the rate story driving the macro trade, there's another one driving the macro trade stateside, Anna. It's coming down to the debt ceiling. Treasury Secretary Janet Yellen says a U.S. government default would undermine Washington's ability to provide international leadership. Speaking at the G7 summit in Japan, Yellen called such a scenario, quote, unthinkable.
A default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced, American businesses would see credit markets deteriorate, and millions of American families that receive government payments would likely be left without the resources that they were promised.
Joining us for more is John Herskovitz, Bloomberg East Asia government editor in Tokyo. John, a pleasure to have you on the show. Walk us through the thinking here. I mean, I think it's a no-brainer that this is going to be a disastrous consequence, one that we haven't seen in history, even though we seem to get closer and closer in each iteration. What is the thinking like on G7? Just how much panic is there?
G7 right now, people understand the situation that's going on and the enormous stakes that are involved. And the comments from Yellen just reinforce what could happen. And she's speaking to an audience that really understands the risk of a U.S. default. Meanwhile, in the U.S., we have Joe Biden. He went out to say to a congressional district in the Hudson Valley of New York, a swing district, to say the world would be in trouble if there was a default. He's trying to pick off a few Republican votes. So we have this push at the global level with Yellen and this local level with Biden, just trying to get a vote or 2 or 3 or 4, whatever he can get, to get the votes that he needs on this crucial piece of legislation.
And John, let me ask you about another talking point over there at the G7, and that is around all things China. We mentioned in our headlines the thoughts around economic coercion, and that seems to be a geopolitical talking point. But in terms of the economics coming out of the world's second largest economy, the inflation numbers, I mean, they're really incredible. The drop down we've seen from 0.7% to 0.1% in year-on-year CPI. This is the kind of move that other central banks globally can only imagine.
Yeah, it's some of the worst numbers that have been seen in a couple of years, and it's really push the idea of whether macroeconomic stimulus or stimulus will be needed in some form. Now, we have the economy that's just really on the ropes coming out of the pandemic, the COVID zero policies. And at the same time, we have the G7, which has China clearly in its sights. The idea that they see China as a coercive power, and they want to take it on. Now, there's some debate as to whether this would mean decoupling, separation from China, or just de-risking, making China less crucial to global supply lines for key materials. But the G7 is looking at China, trying to see what they can do to minimize its importance in the global supply chains. So Beijing is getting squeezed domestically and on the international front.
John, thanks very much. Bloomberg's John Herskovitz in Tokyo for us, wrapping up some of the threads, some of the news lines coming through from those G7 finance and central bankers meetings. And don't miss our interview with Janet Yellen. You heard from her earlier. She's been talking at those G7 meetings. She's going to be speaking to Bloomberg tomorrow morning at 3:30 a.m. in New York, 8:30 a.m. London time. Now, the ECB Governing Council member Joachim Nagel is among the finance chiefs attending the G7 meeting. In an exclusive interview with Bloomberg, Nagel refused to rule out that interest rate increases could persist beyond the summer.
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
Joachim Nagel there. Alexander Weber joins us, Bloomberg European economy reporter in Frankfurt. Alex, good to speak to you. So is the consensus, what does the consensus look like then around the ECB? Is there a slight move towards a little more hawkishness, all this talk of ongoing hikes?
Yeah, it is definitely notable that Joachim Nagel and some of the other officials who've spoken recently are refusing to endorse market expectations, which are for just 2 more hikes in June and July. That reflects, as Joachim Nagel just said, concerns about really sticky core inflation and a sort of impatience that inflation isn't coming down fast enough. We've also heard from Isabel Schnabel, who said the ECB is going to hike until there's a sustained fall in core inflation. So far, we're still some way away from that because we've only had a very small dip in that gauge so far. On the other hand, there are officials like Bank of France Chief Eduardo Gallo who say the hikes are soon coming to an end. So even if we're talking about September now, we have to remember that there are still 4 more inflation readings coming in, 2 more sets of forecasts from the ECB. The ECB is very, very data-driven at the moment, so it'll be largely shaped by the data what's going to happen.
A perfect segue to talk about the survey of consumer expectations. What could the ECB do with that data? Just how much insight would we get?
I mean, it's definitely will be taken as a sign of concern. The ECB is watching inflation expectations very closely because they think that if they get stuck above the 2% target, they could perpetuate inflation. The survey has shown in recent months that inflation expectations had been declining among consumers, and now there's a very sharp bounce back up that will not be taken lightly by the ECB. It may reflect the fact that core inflation has actually continued to accelerate at the beginning of the year. So we need to watch how this develops in the coming months and what any turning point in core inflation, how it will affect these inflation expectations by consumers.
Alexander, thanks very much. Bloomberg's Alexander Weber there in Frankfurt for us. Now in earnings news, Disney posted a drop in streaming subscribers and predicted a wider loss despite CEO Bob Iger's aggressive cost-cutting strategy. Joining us now to discuss, Bloomberg's Alex Webb on set with me here in London. Good morning to you, Alex. So what does this subscriber loss, what does that mean for Disney? Because I thought the focus was supposed to be on profits and not subscribers this time around.
Yeah, I mean, I think what we've seen with Disney is they're in the middle of a bit of a pivot. They had really gone all in on Disney Plus in the effort to become a growth stock. Of course, growth stocks now, given the economic circumstances, given the rates conditions, are being punished. So they're sort of pivoting back a bit towards value. The CEO has suggested that the dividend might maybe reintroduced later this year. What Disney Plus itself is in the broader spectrum of streaming services is clear it's kind of discretionary. Like Netflix might be considered the base layer for some, and you add Disney Plus if you want it. Changes to new advertising tiers, things like that, have helped or hurt the business, reduce the number of subscribers.
Well, to Anna's point there about the subscriber story, I mean, everyone was talking about how the parks business was going to be kind of the redeeming factor for Disney, and perhaps where a lot of Bob Iger's specific cost efficiency plans showed up. What have we learned about that part of the business?
Things really worked actually there, particularly in the international business, which returned to profit after having been loss-making. They posted quite significant profits in the park business, which now represent almost 3/4 of total profits. So it's, when you think about the way Disney is valued and when it was getting those huge valuations during the lockdowns on the basis of Disney Plus, a huge chunk of that business remains what some might consider a relatively stodgy theme parks business.
Alex, thanks very much. Alex Webb with analysis on Disney earnings. And we'll get more thoughts on Disney, the report they put out, what's the future looking like for this business. Citigroup's Managing Director, Jason Bazinet, joins us a little bit later on to talk us through his thoughts on the business. Coming up, Callum Pickering will be with us, Berenberg senior economist. We'll mop up inflation data from the US and China, the world's two biggest economies. Really fascinating stories. We also get the Bank of England rate decision, of course. Plus, Bloomberg is live at the JP Morgan Global Markets Conference in Paris. Later today, we will be hearing exclusively from JP Morgan CEO Jamie Dimon. That's at 8:15 New York time, 1:15 p.m. if you're in London. Earlier today, we heard from Franklin Templeton CEO Jenny Johnson.
Banking is a game of confidence, right? And so if there suddenly becomes a wave of people who, via social media, start to say, oh, I'm worried about this, suddenly you do see this withdrawal. Hopefully that's calmed down and we won't see it. I don't know that we've fully seen the implications of what's happened with some of the regional banks, but I think we shouldn't see too much more.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Today, Bloomberg continues its coverage of the JP Morgan Global Markets Conference in Paris with an exclusive interview with JP Morgan CEO Jamie Dimon in the wake of the bank's purchase of First Republic. Join Francine Lacqua at 8:15 a.m. Eastern as they discuss the banking crisis, taming inflation, jobs, and more. It's all happening live on Bloomberg Television and Radio, your global business authority.
This This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we're talking a lot about the bond market, but let's not forget the stock market lacking a little bit of direction. If it's still all about earnings season, well, this chart will perhaps do you some good. For our radio audience, stick with me here. We are looking at the Citi Index that shows earnings revisions. And really what you need to know is you're seeing a whole lot of red going all the way back to, I want to say, the spring of 2022. So it has been a rough year for S&P 500 earnings specifically. A lot of people saying the recession we're talking about in the economy that's been just around the corner for the last 2 years or so. Well, the earnings recession is in the rearview mirror. It already took place as part of the carnage of last year. But here's the good news. There's a little bit of green on the screen, essentially saying that the forecasts are now coming in a little bit higher. Revisions are actually surging. So if that's the case, why is the equity market not moving higher? That's the question we're going to ask our next guest. Sagarika Jaisingani joins us, our Bloomberg Equities reporter. What is the stock market waiting for if the earnings are coming in strong?
Thank you, Kriti. Absolutely. I mean, earnings have certainly been better than feared. In fact, the guidance that we've heard from company executives has also held up. And yet, exactly as you said, the stock market reaction has been pretty muted. In fact, to just give you some context, the S&P 500 is only nearly flat since the beginning of the season in mid-April. Now, there's a couple of mixed signals that's driving that. On the one hand, the CPI numbers yesterday were certainly seen as encouraging for a pause in the pace of rate hikes by the Federal Reserve. But on the other hand, there's still lingering worries about the health of U.S. regional banks and more broadly of a U.S. recession later in the year. So,
yeah, so that's obviously weighing on things. I mean, stocks look a bit brighter this morning, don't they, Sagarika? Yes. But to your longer term point, I'm sure, yeah, fairly range bound. What about other things that markets might be watching in the earnings story, like buybacks, for example? We noticeably heard some of that from some in the energy space, but maybe not quite what they were previously. So how's that story developing?
Absolutely. I think buybacks was a very strong theme at the start of the year. In fact, January got off to a record start for the U.S. That trend, unfortunately, has not held up as we've proceeded through 2023. In fact, data from Goldman Sachs earlier showed that U.S. buybacks fell 21% in the first quarter compared with last year. And strategists say that they sort of expect that to continue through the rest of the year. So they see lower spending on both buybacks as well as dividends for the rest of 2023 as companies shore up more cash for CapEx and R&D, given the uncertain macroeconomic outlook. So that's certainly turned from a boost factor for equities to a pressure point through the rest of the year.
Sagarika, thank you very much. Bloomberg Sagarika Jaisingani joining us there with analysis on the equity side of things. For more market analysis across asset classes, check out the Markets Live blog, MLIV Go. That is the function to use on your Bloomberg terminal to find the Markets blog. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking to do.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Big ideas, we show the productivity increases that are possible
because of artificial intelligence, it's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. For a third day, Israel and Palestinian militants in the Gaza Strip exchanged fire. Islamic Jihad squads launched more than 500 rockets towards Israel. Meanwhile, Israeli aircraft killed the group's chief rocket maker in Gaza. Efforts to reach a ceasefire have not worked. Ukraine is preparing for a counteroffensive against Russia, armed with more than $30 billion in weapons supplied by its allies. But the weapons may not be enough. To be successful against the larger Russian military, Ukraine will need to execute what's called a combined arms operation. That means coordinating infantry, armor, and air defense to maximize the impact. Donald Trump is urging Republican lawmakers to either get President Biden to agree to spending cuts or push the U.S. into its first ever default. The former president spoke at a town hall event with CNN in New Hampshire. He holds a tight grip on the Republican Party, and polls show him as the frontrunner for the party's presidential nomination. Microsoft has become the latest U.S. tech giant to tighten its belt. The software maker will freeze pay for all full-time workers this year. In a memo, CEO Satya Nadella said the move is necessary to generate funds to invest in the major platform shift towards artificial intelligence. Anna, there's that buzzword again, AI, when it comes to Microsoft. But at the same time, really looking at those cost-cutting measures and something that in the past the stock market has rewarded.
Right, yes, it has done. It has done. You wonder how long that continues to be the case. I mean, what's interesting here is there are sort of two drivers, aren't there? There's the AI driver that you mentioned, which is all about the sectoral shifts within the technology space, the way they need to invest to embrace this kind of technology to keep up, essentially, or perhaps to set the pace if you're Microsoft. But then there's also the macro trends, and we've seen others caught up in that as well, the likes of Meta and Amazon, and things proving difficult as rates rise for those in the technology industry, having to prove that they're more efficient. But if you think about, I mean, keeping salaries stable. I mean, this is a real terms pay cut, isn't it, for people who are in the US with 5% inflation or in the UK with 10% inflation still. That's how it feels when you take that pay home.
It absolutely does, and especially remember we're still talking about a war for talent when it comes to Silicon Valley and Wall Street. Right now, when it comes to an extremely tight labor market, a lot of folks, whether you're in software engineering or AI or coding or whatever it may be, they can easily pick up and go. So Microsoft really playing it hard when it comes to talent. I'll also say to your point, the key word that you use when it comes to the artificial intelligence battle is the word prove. Bloomberg Intelligence's Mandeep Singh says, look, there's a lot of people making big investments in AI. Not all of them will pay off, and that seems to be where the market is almost dislocated when it comes to pricing in the success there.
Yeah, that's an interesting take. And interesting that they actually talk about the tightness of the labor market, but actually maybe see it a little differently over at Microsoft, talking about how things have changed on the labor market front and on the consumer demand side a lot over the past 12 months or so. And so Satya Nadella and team seeing things evolving pretty quickly, I suppose, on the macro backdrop. Coming up, we'll talk macro then, Chrissy. We'll talk to Callum Pickering from Berenberg, senior economist there. We'll talk to him about the state of the US economy post that inflation data yesterday. Of course, we can take in China and the incredible drop in inflation coming through from the Chinese market, but also build up towards the Bank of England rate decision. We are expecting to get a 12th straight increase in rates today from Threadneedle Street. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. G7 nations will announce a joint effort to counter what they see as economic coercion by China. Meanwhile, Treasury Secretary Janet Yellen fires another warning, saying the debt default would hurt U.S. international leadership. The Bank of England comes out today with another decision on interest rates. Economists expect a 0.25 percentage point hike. And shares of Disney are lower. The world's largest entertainment company posted a drop in subscribers to its streaming service and warns there's going to be a wider loss this quarter. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot today just on the macro front, but I got to say, a little bit of a stalemate. Yet, on the earnings front, things seem to be moving. What do you see?
Yeah, here in Europe, we see European stocks moving a little bit higher, up by around 0.5%. Consumer products and services, that was the best performing sector last time we checked in a little earlier on this morning. We're seeing most sectors in Europe in positive territory, picking up on a little bit of the strength coming later in the day yesterday on Wall Street that perhaps we missed out on. But then US futures have been pointing higher as well. So backward and forward looking, there seem to be drivers to the upside for European stocks. So we go higher on European stocks. Man Group, just worth a mention because there will be soon change at the top. Luke Ellis is going to retire as the CEO. The current president is going to be made the new CEO over at this incredibly old and storied hedge fund, of course, the world's largest listed hedge fund, and they're going to put a woman in charge of the business for the first time, so worth a mention there. The euro is at 109.30, down around 0.5% against the US dollar, on a day when we saw maybe at the margin some more hawkish commentary coming through from certain ECB officials, certainly an acknowledgement that hikes are still ongoing at the ECB, but I suppose we heard that last week from Christine Lagarde, no pause. The pound is at 125.89, down by 0.3% for the UK currency. We're waiting, of course, Chrissy, for details from the Bank of England, both on the size of the hike. The market is expecting to get a hike of 25 basis points, so we'll look for confirmation of that, but also any guidance about the future. We'll get into more conversations on that shortly.
Yeah, and a ripple effect that you're definitely going to feel stateside as well if it all comes down to the rate story and whether the BOE is essentially the last hawk standing when it comes to tightening rates. Well, that's going to have a ripple effect on the bond market, on the currency market, and then as a function, the stock market as well. For now, futures higher by about 0.3%, taking their cue from Europe, Anna, and essentially the momentum you are seeing there. But again, anything can change in just 3 short hours. A 2-year-old at 3.91. It is starting to pair a lot of those losses that we saw earlier in the session. So you are starting to see the yield actually come down just a little bit, but still higher by about 1 basis point. Again, it all comes down to the BOE. What do they suggest and what are the ripple effects for the rest of the market? The dollar taking its cue as well. Yields higher, but only marginally. The dollar seeing a little extra strength, higher by 0.3%. But again, a pound could change that. More action there at least could change that. NYMEX crude trading at a 73 handle. Interesting to see a little bit more of risk sentiment in crude and commodities reflect what you're seeing in the future story, because Anna, commodities are not necessarily kind of that recession gauge that we are so used to using them for. Instead, trading more on, again, sentiment and what the stock market and arguably what the bond market is telling it to do.
Absolutely. Let's get into our next conversation then, Chrissy. Callum Pickering joins us, Berenberg's senior economist, on the day when the Bank of England meets to set interest rates. Callum, very good morning to you. So one of my colleagues said Happy Bank of England Day. I don't know if that's the correct greeting in the City of London, but maybe we'll make it a thing. Callum, talk me through your thinking then from the BOE. A 12th hike expected, 25 basis points, 7-2, the vote split. Those seem to be the expectations. What's your thinking?
No, I agree. I think the money market basically has it right. 25 basis points virtually guaranteed. I think almost all market economists are thinking the same thing. The question is going to be whether or not the Bank of England go again. We're looking probably at an upside risk for June, but it's certainly not guaranteed. What will matter is the Bank of England's forward guidance. Do they go Fed or do they go ECB?
Probably in the middle.
They stay in the middle. There will be data dependent, which means the complication for markets is what is the Bank of England forecast for inflation? And within the overall forecast, there will be a 3-month forecast for headline inflation. So basically, whether or not they hike in June will depend on where inflation comes in the next couple of months relative to what the Bank of England forecasts. So we probably don't find anything out today, actually.
Okay, right. Well, that's going to be interesting in itself, I suppose, or infuriating. There seems to be this classic split in expectations between what economists are saying will happen in the next few months and what the markets are saying. A lot of economists saying this could be the last hike, whereas markets seem to have priced in a couple more. I mean, where's all that coming from?
Well, I think this should be the last hike, actually. All of the forward-looking data suggests that the Bank of England can look forward to some significant disinflation over the next few months, quarters. And keep in mind, for the UK, fiscal policy is tight. It's not tight in the US, it's not tight in the Eurozone, so that's also disinflationary. The market is duly reacting to the upside surprises in inflation data. The Bank of England thought in Q1 we would get 9.7% year-over-year average. It came in at 10.2. That's a big upside surprise. What I expect to see is the market basically come down if inflation comes in line with the Bank of England's expectations. And so I think the market needs to come back just a little bit.
Yeah, we kept thinking, Chrissy, that we were going to get these prints below 10%, and we kept being denied. We'll see what the Bank of England has made of that.
Yeah, not a great sign, especially when you're dealing with a cost of living crisis that I believe at the IMF spring meeting said would last years, and not certainly seeing the pace of recovery that we're perhaps going to see stateside or even in the EU. Callum, to that point, just when or what a kind of a beacon is the Bank of England looking for to take the same stance as the ECB and as the Federal Reserve that, you know, now it is the time to stop hiking?
Well, I think the problem that the Bank of England has is if you were to speak to the economists and policymakers, say, well, where do you think inflation is going to be 18 months from now? I think the consensus would be below 2%. And on that basis, you say, well, why are you hiking any further? But keep in mind, inflation data came in above expectations in context of an economy that was much stronger than expected. Now, I'm basically a known optimist on the UK, but even in the middle of last summer, I was expecting a 2.5% decline in real GDP over the course of winter. And instead, economic activity has been flat. So there's been a huge upside surprise in output. So if the economy is stronger than expected and inflation is coming in higher than expected, that is a signal that the economy is tolerating higher interest rates better than the Bank of England had anticipated. And so caution argues for the Bank of England to keep edging up. But once you get that inflection on inflation, then you can look to the forecast and say, well, let's just consider where the economy and inflation are heading. But we're just one meeting away from that, I think, and then June will be the decisive meeting.
So, Callum, that's the rates picture. Let's talk about the quantitative tightening measures of the BOE as well. What can we expect on that front? Any sort of course correction there?
No course correction. The Bank of England is very confident that the UK banking system is well capitalized and has enough liquidity to tolerate any risks from the US market. That's important. And second, the bond market seems to be stable. I actually don't like the term quantitative tightening. I would prefer if we called it quantitative reversal. Why? Because the Bank of England, like the Fed and the ECB, are basically saying this is an operational consideration. We intend to do no tightening whatsoever. If markets are calm, this happens in the background, and then we'll pause if we see some problems in markets on the financial policy side. And so I don't expect anything economically significant from the Bank of England on QT, excuse me. It will just be in the background. We're going to continue this quantitative reversal, focus on interest rates as the marginal policy tool.
And Callum, going a little further afield, of course, all this taking place in the backdrop of global markets, there's a lot of focus on the debt limit in the United States, and those conversations ongoing. We expect that to continue up to the well, who knows, X day, early June perhaps. How are conversations with clients going on around this? I mean, are you taking our clients and the conversations adopting some nuance, or is it very binary as to sort of either it happens or it doesn't happen and you prepare accordingly?
Well, so the US economy is the conductor of the global economic orchestra, absolutely no doubt. So what happens in Europe depends a lot upon what happens in the US. And so rightly so, people are nervous, but also no one really believes that the US will default, and they shouldn't either. So probably you do get some political fix. When and how that happens is uncertain. We've been here before on a number of occasions. For Europe, it really matters because the US is likely to head into a recession this year, mild recession with a lowercase m, but politics can have a bearing on economics. So if things really go the wrong way in the US, that points towards a deeper economic recession. And then Europe, which so far seems to have skirted a recession, is looking forward to a recovery, would then have to worry about more downside risks.
Okay, yeah, we certainly had a guest on yesterday, earlier on Bloomberg TV, formerly of the MPC, now an advisor to the Chancellor in the UK, who was talking about the linkages and suggesting that this debt ceiling debate could be something that slows the pace of rate hikes in Europe. Callum, thank you very much. Thanks for your time. Thanks for joining us. Callum Pickering of Berenberg. Let me just get to some breaking news crossing the Bloomberg just in the last few minutes. Saudi Aramco is set to postpone its IPO of its energy trading unit. There had been a plan to list the business in Riyadh in late 22 or early this year. They were seeking a valuation of more than $30 billion. The reasons that are quoted by people familiar with the matter who've been talking to Bloomberg, the business now feels it'll be difficult to list such a large business on the Riyadh bourse at the moment, and the Saudi firm also wants to take more time to complete the integration of its main trading unit with the trading arm of its US refining business, Motiva Enterprises. So a lot to think about when it comes to that listing story and no doubt the energy markets. Coming up, we will get back to some of the corporate earnings stories we've been following over the past 24 hours. Disney in focus. Jason Bazinet joins us, Citigroup Managing Director. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Has Bob Iger lost his magic touch? Disney shares are falling in the pre-market. It kind of seems like it based off that. That's coming after another drop in streaming subscribers. Joining us now to discuss is Jason Bazinet, Citigroup Managing Director. He's got a buy rating on the stock and a $130 price target, implying about 37% upside. Jason, a pleasure to have you on the show. Thank you for waking up early for us. This story of cost efficiency is something that is going through all tech names, if you can include Disney as officially a tech name. Talk us through whether or not Bob Iger has delivered that cost efficiency in the first quarter.
Well, they did in the first quarter, but as you pointed out earlier, they noted that the losses on the streaming side are going to get a little bit bigger in the next quarter, and I think that's given the street some pause. If I could just sort of frame it for you, I mean, Disney last year did $11 billion of EBIT, and there were $4 billion of losses embedded in that number on streaming, and so the street is just laser focused on getting those $4 billion of streaming losses to zero by the end of next fiscal year. And so this step backwards, if you will, that the company telegraphed, I think is giving the street a little bit of jitters today.
So where does that come from then? When you're talking about making those changes, bringing that number down to zero, does that happen in the streaming business or does that happen in the parks business and the amusement business, which I believe the consensus from the street was that this time around, this quarter, that was really where most of the growth was going to come from?
Yeah, no, that $4 billion of losses is all in the streaming business, and the street is focused on the streaming business going to break even by the end of fiscal 24. The parks business, you know, there the concerns are a little bit different. It's a little bit macroeconomic. Those are the jitters, but they put up very good park numbers. And so there's no concern about a recession, at least in these numbers.
And in terms of that streaming business, good morning to you, Jason. They seem to be taking action on both the costs and on the prices. Bob Iger talking about how they want to increase the prices of their ad-free Disney Plus service. They're also looking to bring down costs, though, by removing some films and TV shows. How does the math look on all of that? Is that going to be enough?
Well, it will be enough. I would add to that they're going to take a $1.5 billion to $1.8 billion write-down to sort of get rid of some content where the cash was already spent, but those costs are being amortized through the income statement. And so that's a third leg of the stool, I think, that's going to be needed to get to break even on the streaming business. You know, the price hikes that Mr. Iger talked about is very consistent with his message from prior quarters. They think they've underpriced the streaming services when they're in the mode of trying to get net ads. Now they're much more focused on profits. And then there's another element to this as well, which is they announced yesterday that they're going to, in the U.S. at least, combine Hulu and Disney Plus into a single app. That eventually will allow the firm to remove some duplicative infrastructure costs that are now being borne by the company to support both the Hulu platform and, quite separately, the Disney Plus platform.
Okay, and what does that tell us about the future around Hulu? Because I know some people have suggested that this move means they could end up buying Comcast 1/3 stake in Hulu, but others suggest this means something different for Hulu. So what's the future there?
Well, this is a little bit confusing. There is no doubt that the street would love to see Disney get rid of Hulu. The street is not a fan of Hulu. Mr. Iger last quarter called, he said he was uninterested in undifferentiated general entertainment content, which was code for Hulu. This quarter, it's still, the negotiations are still in flux, but I think the buy side probably nudged up the probability that Disney is going to end up owning all of Hulu. And so the street would say that's a negative. I look at that and I think it's a positive. I mean, one of the really interesting things from my perspective is, as all of these media companies focus on cost cuts, there is really nobody other than Netflix that is out there that really has the breadth to be what I'll call a pay TV substitute, right? All the other services are sort of niche-y. By bringing Hulu and Disney Plus together with Disney's scale, you're actually in the same zip code as a Netflix. Most of the other streaming apps that are out there are not in that zip code. And so I think it's quite good and quite bullish for Disney long term to actually be sort of the TV substitute in a streaming world.
Well, Jason, let's talk about the cost efficiencies that you are laying out, but in the context of the writer strike that we are seeing in California right now, to what extent is that going to eat into the bottom line when it comes to higher wages?
It's really small. If you look at the Writers Guild and their ask, they would say that what they're asking for is about $500 million a year. What the studios have offered is worth about $100 million a year. So that's sort of the bid-ask spread between the two. If you took that $500 million a year, let's just say that the studios gave the writers everything that they wanted, and you put a multiple on that business that's higher than where a lot of the media companies trade, it represents about 2% of the market capitalization of all of the Hollywood studios. And I'm not even including, some companies that would be in that business. I'm just talking about the companies that we cover. So it's really small. It's not really a large factor at all.
Only 2%, but certainly some developments that we're going to be keeping our eye on. Jason Bazinet of Citigroup, we thank you as always. And of course, he's talking about a $130 price target, about 37% upside. When we take a look at how it's trading in pre-market right now, still got a ways to go, trading with about a 95 handle, down about 5.4%. Again, still very sensitive, Anna, to those streaming losses and the idea of shifting the focus more towards the parks business, which, by the way, was pre-COVID a good chunk of their core business. Feels like the narrative has been a little bit lost there. Nevertheless, those shares down about 5%. Another stock, of course, in the kind of tech arena, if indeed we can call Disney part tech, is Google. Those shares are higher by 1.7%. Alphabet, excuse me. Google entering the foldable market with about $1,800 phone in a direct rival competition to Samsung. This is really important. Samsung is the primary kind of iPhone or smartphone maker, for a lot of the emerging markets. So Alphabet, if it were to break into that market and eat into that market share of Samsung, could mark some very significant upside for Alphabet, and that's exactly what the street is smiling on this morning, higher by 1.7%. And speaking of things moving higher this morning, let's talk about Robinhood. It has taken a beating for quite a while, but overnight, Robinhood talking about bringing 24-hour trading on weekdays, pushing the stock higher by 4.7%. This is during their earnings, of course. Now, earlier in the session, I should say after hours yesterday, you saw an immediate double reaction to the CME group. Essentially, the idea that you are not going to need traditional exchanges anymore if you have something like Robinhood that's going to talk about 24-hour trading. It seems in pre-market, we're still seeing a little bit of unchanged action right now, but keep an eye on the stock because as you see Robinhood trade, some of its other peers, like CME, for example, may take a little bit of a hit, Anna.
Christy, just getting to some breaking news across the Bloomberg terminal then. A CDS panel is going to be asked if Credit Suisse AT1 wipeout is going to trigger a payout. So this is what happens to all those who bought insurance against default on those AT1s. The AT1s were wiped out, of course, by the deal between UBS to buy Credit Suisse. And so that is something we're going to be watching. The panel involved is the Credit Derivatives Determinations Committee. They're going to be deciding if this AT1 wipeout is a trigger payout, if it will trigger compensation for insurance holders, essentially. This is Bloomberg.
Connection lost. let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
There is a real risk that Sunak's inflation target won't be met, and I actually think he would have done better to leave discussions of inflation to the Bank of England.
That was the former Bank of England MPC member Martin Wheal speaking to Bloomberg's Lizzie Burden. Sticky inflation in the UK looks to be putting pressure, of course, on the Bank of England to continue hiking rates today. And Lizzie Burden, who was talking to Martin Wheal there, is with us now. She's outside the Bank of England for us this morning as we build towards a decision which comes in around an hour's time. Lizzie, what do we expect?
Well, I know markets and economists are in agreement this time that rates are going to rise 25 basis points to 4.5%. It'd be the highest level since 2008. So the real focus today is the future path for rates. Any hints on that from the governor and his colleagues at the press conference and the interviews that will follow, as well as in the forecast. Now, markets are predicting that they're going to hit 5% potentially by September. But we were speaking to Sushil Wadhwani, former Bank of England policymaker, yesterday on Bloomberg Radio, and he said that would be unwise given the potential spillover risk from a US recession, given all the recent turmoil around regional banking there. In terms of the vote split today, we're expecting 7-2. That's what economists reckon. It would be the same as last time. But the risk would be that you've got hawks on the committee who could be spooked by that recent upside inflation surprise and actually go for a 50. But at the other end of the spectrum, you've got doves like Silvana Tenreiro who say you need to take account of the lag in monetary transmission. It takes 18 months to 2 years. She says being a hawk right now is like being a fool in the shower, turning on the tap, keep turning it, not being patient enough to wait for warm water and scalding yourself in the process.
An experience I can certainly relate to. Lizzie, in about 30 seconds, how much forward guidance will there really be?
Well, you've got to ask how credible the Bank of England can be if it does anything other than say that it's data dependent, given all the surprises we've had on inflation and the labour market recently. But it'd be interesting to see where the Bank of England reckons inflation will end the year, given what Martin Wheal just said. It's the Prime Minister's #1 target for it to halve by year end. Only a few weeks ago, it was seen as unambitious, as ambitious as saying that the sun's going to set at the end of the day, but now it looks like it's in doubt.
Lizzie, thank you very much. Bloomberg's Lizzie Burden for us outside the Bank of England, and certainly we'll continue to cover the Bank of England story as it develops today. We'll bring you their decision, of course, and any forward guidance we do get. That is it for Early Edition. Don't miss our exclusive interview with JP Morgan CEO Jamie Dimon at 8:15 New York time. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Inflation is headed back to goal, but they have to be confident that it's headed back to 2%.
We've seen the noise in the data, right? Like 1 month doesn't make a print.
There are some risks still on the downside in terms of the economy. At the moment,
it really does just come down to the stickiness of core services inflation, and that's the inflation that's worrying for the Fed.
The CPI headline inflation rate will be below 4% by June. We're pretty confident.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A lesser inflation in America, a greater inflation in the United Kingdom. Lisa, the comments over the Bank of England announcement. I mean, Jamie Dimon is with Francine Lacroix this morning. We've got the Disney debacle. You weren't watching enough Mandalorian.
I'm sorry.
None of it matters. The Bank of England, this is a stunning difference between the United Kingdom and what we saw yesterday on the show in America.
Hiking into weakness and acknowledging it. And we have seen this repeatedly from the Bank of England, basically saying things are going to get worse. We need them to get worse in order to bring down inflation that is still double digits, even after 11 consecutive rate hikes.
We've got the perfect guest for this coming up in moments. Jeffrey Yu will join us here on really the cultural approach to whipping inflation now in the United Kingdom, or whipping it here. Let's first go to what we saw yesterday. In America, Mike McKee nailed it with his service sector rigged new index that Chairman Powell's looking at. Things look pretty good.
Well, things are coming down, and things are coming down as expected. The question is, where do we go from here? How messy does it get in the process to head down, and where do we stop? I do want to say today, and I'll get to it in the brief, but we're going to get factory price inputs. And this, to me, is going to be very interesting because one thing Paul Donovan of UBS pointed out, factory prices are rising at a slower pace than the prices that consumers are paying. That means higher profits for companies.
This is CPI and PPI. PPI used to be hugely watched, like last in, first out, and, you know, days of high inflation 20, 30 years ago, and then it drifted away. And I agree with you, it's got some real merit here today. Here's the inflation structure in America for those keeping score at home. Services inflation, the peak was 7.3. and 7.1 and 6.8, and that's a vector McKee's talking about, which is it's moving in the right direction. I looked at the United Kingdom this morning, and it's like on the edge of double.
10.1%
Inflation, yeah.
inflation in the prior reading, and this comes based on expectations that were 9.8%, right? It's not coming down quickly enough, even though the real economy is clearly slowing. What do they do with that? I mean, do they just acknowledge, look, inflation we got to bring down, even if it torpedoes all economic growth?
You're going to do Disney in the brief, but quickly, it didn't happen, did it?
Well, it did the subscriber growth. That's the concern, that they did not add the subscribers that they were hoping for. We'll get to that later on, but what we're looking at today very much is what's going on with the Bank of England as well as PPI, the inflation read. We get at 7 a.m. that ECB rate decision. Very curious to see how they parse the weakness in the economy with, frankly, wages that are also keeping pace on the margins in some categories with inflation. What do they want? Do they want to induce a recession? Do they come out and do they say that based on some of their prior suggestions as well? 8:30 a.m., the read on inflation in the U.S. PPI. What's interesting to me is it's fallen significantly below where CPI is, where the prices that consumers pay. So if factory prices are lower and consumer prices are higher, guess who's capturing the margin? That is corporate profits. This is sort of the confusion of the moment we're in, where companies can make bank even though consumers are feeling the pinch. And at 10:15 a.m., pulling it all together, Fed Governor Chris Waller is speaking at a financial stability conference in Madrid. Very curious how financial stability weighs in on the decision of how far to go, how long to stay high for the central banks around the world.
And Chris Waller is a research hound. This is somebody steeped in the research of the Fed. I do agree. It's from Madrid, right? Yeah. Even from Madrid, that will be an important thing. Is that all you got this morning?
I have lots more, but let's leave it there.
Let's leave it there for now. Well, Chris, we'll have the stock check with Disney here at the 7:30 hour as well. Futures up 13, Dow futures up 28. The VIX is stunning. Under 17 is 16.73 VIX. I want to be sure I get the melt up here. Amy, bring up, if you can, that chart of the massive melt up we're seeing. 12 months trailing. 12 months trailing on the Standard & Poor's 500 and the Dow is up 5%. That's not a bear market. That's like, we're up 5%, 12 months trailing. And the NASDAQ is up much, much more as well, the NASDAQ 100. Let us look now at the words of Mohammed El-Arian on the huge difference in inflation approach in the United Kingdom versus what we see in the United States. And it's real simple. Dr. El-Arian talking here about a June hike. The case for a rate hike is very simple. Inflation remains too high. There's evidence that inflationary pressures are persistent. We have to follow the Fed. That's a key phrase there, folks. They have to follow an American economy maybe 5-6 times bigger. When you put all those things together, Dr. El-Arian would argue the Bank of England has no choice but to raise interest rates. It wouldn't surprise me if we get another rate increase in June. And Lisa, that's a modern take here on what you see. Now, the gentleman from Stanford, Hugh Pill, the chief economist here for the shop, he came out with statements on the Bloomberg today. Thank you, Reed Lundberg and others in London for this. And Hugh Pill almost said it was cultural and that the people of the United Kingdom have to fall on a sword and spend less. They have to accept the worst. We're worse off. This is completely opposite of the American psyche on this. I can't say enough about that.
It also probably is not received particularly well in the public, and it really raises a question. Hiking into weakness, how long can they do that?
It harkens back to the British take from the Depression. Jeffrey, you with us right now, senior market strategist at BNY Mellon. I mean, Jeff, you are perfect for this with your work at LSE. The British treat sky-high inflation differently than the U.S. does, don't they?
Well, right now, if household income growth is strong, and I think that's one major miscalculation on the OER side and the BOE side. Look at the forecast, and we're waiting for a refresh today, expecting 7 quarters of real income declines, full-year decline this year. I don't think that's going to happen. Real incomes are going to expand this year. So if that is what's happening to the underlying pocket, then why should they not spend that? And why should they not, every man or woman's house is his or her castle, why should they not pursue house purchases? And that's what we're seeing in the real estate market as well. And that generates a wealth effect. It feeds into itself. You mentioned earlier that import prices, so my good friend Paul Donovan mentioned that import prices are coming off, or input prices are coming off. Factory input prices. That matters less for the UK. It's a services-driven economy. Feeds into itself. Job openings, they're rebounding, whereas elsewhere in Europe, they're peaking. So very different dynamics, and that's still driving demand.
Does the Bank of England need to kill that demand? Does the Bank of England need to induce a much more severe recession in order to bring inflation under control? Because hope is not a strategy that people will simply spend less.
Hope is certainly not a strategy. I absolutely agree with you. But given the comments, by various BOE leaders, what they want to do, what they want to induce, whether that can be done, especially as politics start to come through over the next 18 months or so, I think that's a very different story. So I think the Bank of England, so today's communication, they'll be asked about what they are telling the general public and what the public is and how the public will treat these comments. That brings in a new dimension, and I think it's going to factor into not just the leadership of the Bank of England, but let's have a think about all the underlying members as well. So I wouldn't nail it on that they're going to have to hike ad infinitum. So 5%, maybe a bridge too far right now, and they want to see what the effects of all the previous tightening will have on the economy as well.
So if they signal that they're open to potentially pause at their next meeting, which is what some people are suggesting, that this will be the 12th consecutive 25 basis point rate hike, and then stay there for a bit, what will the response be in the pound? Will it crater? Will it rise? I mean, how much are people baking in this facing a 10.1% inflation read?
Well, two things there. Firstly, looking at our underlying flow data, our clients have been buying the pound. They've been buying against the dollar. They've been buying against the euro as well. So on that note alone, just from a positioning point of view, you will see a bit of an adjustment to the downside. Risk is to the downside. And on the other hand, having a strong pound, that impacts inflation less in the UK. It's a services-driven economy. If there's strong services demand and the input is domestic wages, and we see strong labour market tightness in the UK, even having a strong pound, a weak pound, that's not going to make too much of a difference. So it does go back to the demand story.
Jeff, I look at this, and it goes back to the word no one speaks about within United Kingdom political economics, and that is austerity. There seems to be an immense embedded elite comfort in telling the British people that they must be austere. Overlay that with the reality of year 3 or year 4, whatever it is, of Brexit. Tell me about British comfort with austerity. We have to hold back and spend less in this experiment of Brexit.
Well, put it this way, former Prime Minister Johnson basically pledged that this will not be the age of austerity anymore, be the age of levelling up. So Chancellor Hunt, right now, he's not putting it insofar as austere terms, but there is a need for retrenchment. There is a need for restraint, and tax and cuts can happen further down the line. I would say most of the debate right now is on the corporation side. But again, going back to the politics, going back to what's happened in the local elections, political giveaways, fiscal giveaways, that's a tradition in the UK ahead of elections. So what I worry is heading into autumn, we're going to start talking about fiscal easing. So that's inflationary just when the BOE is thinking about pausing. Those timelines do not match up.
Jeff, you quickly here. It's on sterling. What is your call 12 months out on GBUSD?
Still weaker at this point because two things. One, I mentioned the positioning. That needs to come off. But secondly, Fed cuts being priced in right now, far too aggressive. So that adjustment alone should help the dollar.
Brilliant. Political economics with Jeff, for you of BNY Mellon. Great way to start the morning as well. I can't say enough about the difference and an American optimism about growth, an embedded belief that we can grow our way out of this, a little g in the equations, and a British difference, which with Hugh Pill today, again, a PhD from Stanford, he's not all British, but what he said, you just couldn't say that within the American press.
There's a good chance he couldn't say that in the English press either. I imagine he'll get quite a bit of pushback. It's sort of a, let them eat cake, just simply stop spending. There is a bit of that tone to it, and I'm sure that he will be duly received among many people. There is a question of central bankers that are caught between a rock and a hard place, not finding an easy way out of a quagmire that puts them in an incredibly tenuous position. And I think that is really the issue that he is dealing with, which is maybe if you just spend less for 6 months, we can get out of this easily. And a lot of people are saying, it doesn't work that way.
You're the expert on this. Just out CNN talking up that the Biden administration takes the Inflation Reduction Act off debt talks. This is starting to heat up, isn't it?
Well, hopefully there's some progress made. This is something that a lot of people are concerned about as a tail risk, although Wall Street not among them.
Another meeting tomorrow, right?
Yeah, which maybe we'll get some progress in, although former President Trump had some fiery words last night.
And there is a meeting today. It is with Francine Lacroix in Paris. Look for her conversation with James Dimon. We'll do that in the 8 o'clock hour. Stay with us. Good morning. Bloomberg Surveillance.
up to date with news from around the world. With the first word, I'm Lisa Mateo. Donald Trump is urging Republican lawmakers to either get President Biden to agree to spending cuts or push the U.S. into its first ever default. The former president spoke in a town hall event with CNN in New Hampshire. He holds a tight grip on the Republican Party, and polls show him as the frontrunner for the party's presidential nomination. The Bank of England is set to go ahead with a 12th straight interest rate increase, and that's thanks to double-digit inflation. The decision is due at 7 a.m. New York time. Still, the end of the BOE's lightning-quick hiking cycle is coming into view. Economists surveyed by Bloomberg expect a quarter-point increase to 4.5%. For a third day, Israel and Palestinian militants in the Gaza Strip exchanged fire. Islamic Jihad squads launched more than 500 rockets toward Israel. Meanwhile, Israeli aircraft killed the group's chief rocket maker in Gaza. Efforts to reach a ceasefire have not worked. Bloomberg's learned that Saudi Aramco is pushing back a deal that would have been one of the largest share sales this year. The company is delaying the planned IPO of its energy trading business. It may be pushed into 2024 unless the market improves. Aramco was considering seeking a valuation of more than $30 billion. And shares of Disney are lower in pre-market trading. The world's largest entertainment company posted a drop in subscribers to its streaming service, Disney+, and it predicted a bigger loss in that business this quarter. Disney says the loss from streaming will increase by $100 million because of shifting marketing costs. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, Bloomberg continues its coverage of the J.P. Morgan Global Markets Conference in Paris with an exclusive interview with J.P. Morgan CEO Jamie Dimon in the wake of the bank's purchase of First Republic. Join Francine Lacroix at 8:15 a.m. Eastern as they discuss the banking crisis, taming inflation, jobs, and more. It's all happening live on Bloomberg Television and Radio, your global business authority.
Short of a default, brinksmanship over the debt limit can also impose serious economic costs. We know this from recent history. As we learned in 2011, just the serious threat of default can lead to a downgrade of our credit rating and a weakening of consumer confidence.
That was Janet Yellen, Treasury Secretary, speaking overseas at the G7 meeting at a time when it seems like politicians, Tom, are really trying to generate some interest on Wall Street about this debt ceiling debate, that perhaps are getting some interest from T-bills, but not elsewhere.
I think it's not just Wall Street. I think it's the people. There's just an understanding, going back to my sainted mother in a complete panic in the late 50s. The world's going to come to an end. The debt thing, this, that, and the other. Guess what? Cry wolf. It doesn't happen. And that is inured into the people of America.
Which is the reason why you continue to see gains in the S&P and NASDAQ, the reason why people still are optimistic, the reason why this tail risk seems to be taken off the table, that we are going to somehow head into a default. Last night, possibly helping, possibly hurting, it depends on your point of view. Donald Trump, the maybe likely Republican candidate for president yet again, came out and said that he hopes that Republicans demand a actual debt default unless there are massive spending cuts. And this is something that a lot of people are concerned will be the tail risk. James Lucier, senior political analyst at Capital Alpha Partners, joining us now. James, what did you make of that? Was that helpful? How much does he represent a mainstream within the Republican Party?
Well, Trump represents the Republican primary base, but I don't think he really represents the general public very much. And the fact that Donald Trump would come out and say this underlines what I've been writing about, which is the theater that's going on in Washington, the brinksmanship, the kabuki, the catastrophism, exactly what Tom was saying. Washington is desperate for attention. We want the financial markets to come and demonstrate that we're important. But in fact, I think the financial markets and the general public understand the game that's going, and they're not going to take the bait this time. I think there was some risk, something to worry about in the debt ceiling earlier this year, but I think they're going to get it done.
Jim, you have decades of wisdom here on the shifting tides of Capitol Hill, and part of that is a careful analysis of the middle ground. You just mentioned the primary polarity, which shows Trump's success or maybe someone over on the left success. I'll let you pick the victim. What's the power of the middle in the next coming weeks over this debate, and particularly into June, say middle June?
Well, the power of the middle here is that members of Congress have been bottled up. They are there to legislate. They are there to do deals. They are looking for a deal. We're waiting for a Senate gang to come apart. We're waiting for the House problem solvers to come and start offering alternative solutions. And as soon as you have talks at the White House where there appears to be some substance, IRA is off the table, this is off the table, there's a framework, that means that you're going to unleash the hive mind of Congress. That means that leadership will probably be losing control at some point, and you'll have independent actors on the Hill working toward a deal. But more importantly, I think you've got to look at the timetable. They don't have enough time. They'll have to start putting themselves extensions. And I think we're going to see a series of extensions or just a long extension to September.
You have a terrific chronology in your research note. And the word that comes up all the time in your research note, sentence to sentence, is the V word, vacation. Explain how the lack of attendance here gets in our way, even if they kick us the can down the road to the end of the fiscal year, or dare I say into autumn. They're really not there much, are they?
No, they're on planes. They're in and out. They move in and out like the tidal flows in the sea. They come in on Monday evening. They're out on Thursday afternoon if they possibly can. That means that Washington moves in 1 week intervals. It means they're only together in person for very limited amounts of time. And it also means that they can't really respond quickly to new situations. Not only are they constantly coming in and out, but they generally need a pause to process, to think about what happened. So it's always a stop and start, a pause, reflect, new action, pause sort of cycle. And I've been doing this for nearly 40 years, as you mentioned, Tom. There's no real change.
We're going to be talking about the debt ceiling debate with increasing frequency, fortunately or unfortunately for most people probably who are sick of talking about this. At the same time that we're still battling inflation and dealing with what the consequences of the rate hiking cycle will be, how much is the underpinning inflation in the U.S. right now really heightening some of this debt ceiling debate in a way that perhaps it hasn't been even back in 2011?
Well, I think we're seeing a fundamentally different sort of debate than we saw, for instance, in 2008. or during the banking crisis or in 2011, when you still had that Tea Party effect, which was really driven more by the banking crisis than anything else. I do think that thanks in part to Donald Trump, there's a much higher tolerance for spending here. I do think that inflation, or at least the sense that inflation comes from too much spending, driving this cycle, as opposed to, angry people worried about personal debt in the wake of a banking crisis.
Jim Lucier, very quickly here, one final question. We have the privilege of speaking with James Dimon today in Paris. Our Francine Lacroix will be in conversation with him. This came up last night. From where you sit with decades of experience at Capital Alpha and, of course, your tenure of duty at Prudential, and folks, I really want to say the team that Prudential had years ago was best in class. Great. Can Jamie Dimon be a good Secretary of Treasury?
Sure. He's got the skill set. He's got the presentation style. He's got the credibility. I think he'd be a great Treasury Secretary.
Jim Lucier, thank you so much. Greatly appreciate it with Capital Alpha this morning. That's still percolating out there. Like there's a whole group of people down in Washington that hates Wall Street. Oh, we could never have anybody in Wall Street. But, this doesn't go away. This thought doesn't go away. Secretary Dimon doesn't go away. It's there.
Washington, I would argue, is more... is more okay with it. You're going to keep whispering and shushing. There's this issue that
evil bankers.
How much could a banker, or not even a banker at this point, a very wealthy individual who's working in the financial sector, actually get elected? The populist kind of,
elected's different.
And this is actually one of the big questions. I mean, Donald Trump did, and he's a wealthy real estate investor. So there's a question of whether that is off the table. But there is a different nature to somebody who works within more academic and more established circles that seems to not necessarily play with the population of the same kind of.
It's a cabinet position like Yellen, and the answer is, as Jim Lucier said, there is, you're looking for people that have communication skills, and Dr. Yellen, as an economist, has a whole different cadence and pace than what you get from some of our minutiae with Trump and others over the years. I mean, a whole different thing.
Yeah, the question is, would he leave JP Morgan to do that? We shall see. We'll hear from him. Maybe Francine Lacroix.
I'm just trying to stir the pot here. For Francine's out. She's in Paris. Ask Dimon if he wants to be Secretary of Treasury. We'll have to see.
No, but I thought that was interesting how this is all going to percolate. The confidence that something will get done. The confidence that the headline that you mentioned earlier about taking some of the some things off the table in the discussion is actually steps of some concrete kind of progress.
My measurement here in the data check on the tension in Washington is a comparison of the 3-month yield, the T-bill yield, and the benchmark 10-year note. We're back out to a negative 182 basis points. Not record wide, but certainly on a weekly chart showing some real tension there. Even with the better equity markets, and right now S&P futures up 10. I'm looking at the bomber. There it is moments ago, Lisa, back down to a 3.91% in the 2-year. Again, not new lows, but getting there rapidly.
Yesterday, the tone really seemed to be, we got just the expected decline in CPI and headline CPI. And this is incredibly positive and shows that we're disinflating at a rapid pace and that the Fed can even cut rates later this year. To me, this is really the question. Is it going to be a messy process, and is it going to cause a lot of angst as people start to see volatility in the numbers?
Well, the yield structure is lower. There's no question about it. 10-year yield 3.42%. Just some really interesting moves here. And economic data at 8:30. In the 8 o'clock hour, we will have claims for you and PPI analysis as well. Our Francine Lacroix in conversation with Jamie Dimon. Look for that in the 8 o'clock hour. On radio, on television, this is Bloomberg Surveillance. Good morning.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Good morning, everyone. Bloomberg Surveillance on radio and television. John Farrell on assignment right now. He's deep on assignment somewhere.
It sounds like
rumored to be back tomorrow. Rumored to be back. What do you think? 50-50 odds?
Well, depending on the performance of some teams last night, perhaps they'll take an extra day.
Well, he'll need an extra day. We'll get into that later. Lisa Bramwitz and Tom King, we welcome all of you this morning. The data is still that uptick we saw yesterday off the service vector of disinflation. At least it's in place. Vince Reinhardt was brilliant on that yesterday at Mullen Drive. His futures up 10, Dow futures up fractional. But I really want to say 12 months trailing, you've got SPX and Dow up 5%, and NASDAQ 100's got a double-digit pop to it, 12 months trailing.
And it's only been boosted by this idea that we are getting disinflation, and that's really a question. Over in the U.S., perhaps, but not over in England. And to me, the distinction, and you've been talking about it all morning, the distinction is palpable. One and done doesn't really work in the same kind of way in England.
Oh, yeah, the one and done is not out there. I want to sell this to you folks right now. This is not a normal conversation. Francis Lacroix in conversation with James Dimon here in the midst of an American banking crisis. We haven't even mentioned the banks this morning. They're all open for business this morning, right?
Well, actually, speaking of banks, PacWest just coming out with this, that they are going to complete strategic asset sales this quarter, kind of highlighting how the positive signs that we saw in some banks does not apply to some of the more troubled sides of the
Jamie Dimon's going to do a strategic asset sale. It has something to do with the new building on Park Avenue. I'm not sure about that. We'll see.
Meanwhile,
where that goes.
We are about a half an hour away from the Bank of England. And just, there's a question of this 25 basis point hike. Janet Henry of HSBC does expect that. But she's looking for some dissent, something that we haven't been seeing over in the U.S. She wrote, though our base case for this meeting is for a 7-2 vote again, as in March, any deviation from this will get the market's attention. If anything, the risk is that the recent data have spooked the hawks and we could get a few votes for a larger 50 basis point hike, Tom. That would be something that would certainly cause markets to move.
Janet Henry is with HSBC. They have been absolutely brilliant over the arc of this crisis. I'm talking 10 years of a lower rate regime and more subdued GDP. And the back and forth on that, Janet Henry's provided leadership as their chief economist. Janet, what will be the nuance today? I love that the Bank of England is more fractious, including Catherine Mann, a great supporter of Bloomberg surveillance. But what will you look at the actual announcement to interpret the body language of the BOE?
Well, as always, it will be about the vote. And it will be about the language and even a little bit on the forecasts, which are always, their own mystery where the Bank of England is concerned. But I think more than any other major central bank, the Bank of England does have a lot of diversity of views. So as the UK team said in that comment, we expect a vote of 7-2, but it's even possible we get a four-way split. We know that two people were very, very dovish, and if anything, think it's time to cut. whereas we know some of the more hawkish people, which you included as Catherine Mann, actually, in view of the recent run of data, which have been, but not just the pay numbers, the inflation numbers, the business confidence, the consumer confidence, the big mounts in the service sector, PMI, they might be minded to vote for a 50. So I think, anything on the hawkish side would be what would influence the markets as much as they will try to keep the statement quite neutral.
Is double-digit inflation in the United Kingdom, is Brexit part of that reality?
I think there seems to be a Brexit impact on the supply side of the economy, particularly on the labour market, but it's not all of it. There's also the UK seems to have a particular impact on long-term sick. If you look at the US, labour market participation is around pre-pandemic levels. In France and Germany, it's actually above it. In the UK, it's below it, and a lot of it is prime age workers who are long-term sick. But the other impact about inflation that I don't think enough is talked about with regards to the UK is that for that 10.1% print, a huge amount of it is still energy. Headline inflation in the US, energy is now detracting to headline inflation of 4.9%. In the UK, it's still adding 3.2. So we did get a very disappointing reading at 10.1. That's way too high. But I do think, even though I think the Bank of England's forecasts are implausibly low, inflation is going to come down as that energy contribution drops out, which is why, I've been saying the move from 10 to 5 is quite easy. The move for all the central banks getting from 5 to 2 is where the real challenge lies.
Janet, I'm glad that you went there because I was thinking about this morning, are we seeing the end of this global rate hiking cycle? Is this sort of the beginning? Even if it's not this meeting, then it's next meeting and the ECB will be tapering off later this year. Just thinking how messy it is with the data that's going to fluctuate so much. How much in this messiness can the Bank of England come out and say, we're going to avoid recession, or are they going to have to double down on this idea of a severe recession that they really brought up last year?
Well, that's where I think the forecasts will be interesting, because remember, in their last set of forecasts, they had quite a deep and prolonged recession. And I think, like the rest of us, they will probably revise away that recession. It's possible we get a negative Q2. Remember, we've had a lot of public holidays in the UK in May. We've had an extra one because of the coronation. So you could get a negative Q2, but I think they will take away that recession. But where they will face the difficulty in terms of sending a message to markets is probably with still very low inflation forecasts. 2 years ahead, probably still only 1%, 3 years ahead, something like 0.5. So usually they use those forecasts to say the market's expecting too much on interest rates. And the market in the near term, the next couple of months, is expecting quite a lot, but then quick cuts. So it's going to be a difficult communication challenge to say, actually, we don't think interest rates are going to come down so quickly. For now, they'll probably focus on the idea that, they kind of would like to pause. This is where they were last meeting. But if there are persistent pricing pressures and we get 2 more prints before the June meeting, then that would warrant further tightening. But I think the forecast versus the messaging could be where some of the confusion comes out after the meeting.
Janet, do you think that we are entering the end of the global tightening cycle, or do you think that it just is becoming a splintering exercise of different regions with different challenges?
Well, certainly on our forecast, we are at or very close to the tightening cycle for a lot of the major central banks. It's been interesting looking, around the world. You've had some economies where they really are going to be seeing a recession, the likes of New Zealand or Sweden, and entrenched inflationary pressures means they're still tightening, but they'll probably cut more quickly. For the Bank of England, for the ECB, we've got rate rises in June, and then we've got that as the halt. I think it's more likely the ECB continues to raise beyond June than actually the Bank of England, given how their reaction function seems to be coming through. So I think that we are close to the end. But, relative to market expectations, I'm more in line with a lot of economists that the interest rate cuts come somewhat later. Getting inflation confidently back towards target is going to take longer than they expect. unless we get something much worse on the macroeconomic side or the financial side.
Tom was mentioning earlier what we saw overnight with respect to some of the concerns with respect to this idea of a populist feeling, take less, do less, et cetera. As we move forward, how much do you expect that kind of tone to receive pushback from the population and, frankly, a lack of willingness to accept some of the pain that's required to get back down to a 2% level, this question of that last mile that might be that much more painful?
Yeah, that's a good question. I think it's very hard for any central banker to send a message to populations who are facing a cost of living squeeze, and even to firms that have faced big input cost pressures. So to say, please don't ask for pay rises, because if you try to offset your cost of living with higher pay increases, then the whole process is going to take a lot longer. They've also, well, I suppose a certain individual has also said the same to companies as well. Don't push up those price increases. But the fact is, central banks around the world, particularly the ECB and the Bank of England, they know where the persistence on inflation risk comes from will be if wages respond to inflation. So, 10% inflation, you won't necessarily get 10% pay rises, but if you get 4 and productivity is still 0, then actually that keeps inflation much stickier for much longer.
Janet, we've got to leave it there. Janet Henry, thank you so much. Towards the Bank of England meeting today. Maybe it was a bit of a snooze, but it is not now. This tension of a better than expected UK economy versus the worries about slowing down. Citigroup really capitulating. I think it was yesterday or the day before. And I thought their foreign exchange team was just great. We were wrong. They just came out and said we are wrong on the UK gloom, and it's doing better than expected.
I do wonder, though, if that's going to be the same if they keep raising rates, even if everyone else stops, right? I mean, how much can they really fight inflation at a time of 10.1% inflation if they aren't raising rates much more significantly?
The focus is on James Dimon. He runs a small bank. He'll be in Paris with Francine Lacroix. And this is off the radar this morning. This is something we like to do, and I know Dow Jones is on the story as well as Bloomberg. CI Financial is the mother of all asset-backed roll-ups that's out there. It is a small group in, you don't know it, it's a small group in Toronto, acclaimed in Toronto, and CI Financial is going to sell a stake in their U.S. wealth management. I'll be honest, I don't know the details, but what I do know is when I talk about roll-ups, this is the mother of all asset management roll-ups, including part of Eaton Vance, which Morgan Stanley took out years ago. And it's just the future here of getting scale. It's an example of, can you work and get scale? The stock price says it's not working. The stock is basically cratered here and giving them fewer what I call mergers and acquisitions opportunities. But to me, Lisa, it's a perfect example, opposite the ginormity of James Dimon or Brian Moynihan and the others, of how do we get scale? And you see it in roll-ups that are from 2-3 decades ago.
Well, it's kind of the irony, particularly in the financial sector, after a decade of people saying that smaller is better and big potentially is systemically risky, that bigger is actually somewhat more stable right now, and everybody wants to be bigger so that they can succeed and they can be profitable.
And I'll lean forward and listen to Francine Lacroix, Jamie Dimon. We'll do that in the 8 o'clock hour here on the show this morning. Up next, Vasilios Giannakis of Citigroup on United Kingdom. Stay with us.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Former President Donald Trump says the U.S. is spending money like drunken sailors. At a CNN town hall in New Hampshire, he urged Republicans to push for spending cuts or go into a default. He said he doesn't believe a default will happen because Democrats will cave under pressure. The polls show Trump as a front-runner for the GOP's 2024 nomination. Consumer expectations for Eurozone inflation rose significantly in March. That bolsters the case for the European Central Bank officials who say interest rate increases may need to continue past the summer. In its monthly survey, the ECB says inflation expectations for the next 12 months rose from 4.6% to 5%. Meanwhile, in China, inflation at the consumer level has slowed to the weakest pace in 2 years. April's CPI rose 0.1 percentage point from a year ago.
Producer prices fell further, fueling debate about whether more policy stimulus is needed. The Biden administration is cracking down on the pollution from the U.S. electric sector. Proposed requirements released today would force coal plants and the largest gas-fired units to stifle nearly all their carbon dioxide emissions. Still, the plan would spare most natural gas plants, and utilities would have more than a decade to comply with the limits. Microsoft has become the latest U.S. tech giant to tighten its belt. The software maker will freeze pay for all full-time workers this year. In a memo, CEO Satya Nadella said that the move is necessary to generate funds to invest in the major platform shift toward artificial intelligence. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
There's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
Jakob Nabel, the ECB governing council member, but much, much more than that, a voice of hawkishness, I would say. Do I editorialize there? I'm unsure.
Absolutely. He's been very much on the hawkish side.
Yeah, and he's talking the tone there. And again, this gets us to Bank of England Day. The sequence this morning, good morning on radio and television, is Bank of England festivities coming up. I wonder, are they like here in like 14 minutes? Is it like 7:00?
Yeah, 7:00. We get the decision.
Maybe they're going to declare victory. That's what the governor said. I think it was last time or the time before. And then we're going to go on to a conversation with Jamie Dimon, Francine Lacroix in Paris. For that. I do want, we have to stop the show, folks. I mean, there's reasons to stop the show, including when Tottenham wins, which is rare. Krispy Kreme, Abramowitz briefed on this right now. Oh, Krispy Kreme just killing it. I'm sorry. It's a beat, as they say on Wall Street.
I'm not a Krispy Kreme expert in any way, so whatever Tom's going to try to throw on me. Yeah, it is a beat, which is interesting because we have continued to see a beat more broadly. I will say that I was introduced to Krispy Kreme when New York City girl moved out to Fargo, North Dakota, and they opened a Krispy Kreme for the first time, and people camped out overnight to get the first Krispy Kreme donuts, and it was, that much of a phenomenon, and then it kind of lost luster and is making a comeback for the donut Fiends of the world.
News you can use on Bloomberg surveillance. Thank you for that.
I'm sure that was
Bloomberg
really
Intelligence
helpful
will
for
have
people.
much more this morning.
No, they
Gina
won't.
Martin Adams will have an in-depth analysis of the creme to Chris Bay. This is important, folks. It is so important to keep score on Wall Street of world-class frontline analysts who say, oops, I was wrong. It was a wonderful note the other day from Citigroup and from their head of European FX strategy, as Vasilios Giannakis said, you know what? It ain't that slow in the United Kingdom. I don't know if it was Charles III that put him into a better a plane, but what we know is Vasilios Giannakis has recalibrated at Citigroup. Vasilios, what surprised you most in the dynamics of politics and economics that turned the United Kingdom around? What was the factor, let's be kind, you most got wrong?
Oh, absolutely, Tom. Look, I think looking at the likes of similar mortgage-structured economies like Sweden and New Zealand, the housing price correction has been about 15%. In the UK, from the peak, it has only been 4%. And we have to admit that the resilience of the housing market has been quite remarkable. Now, it could be that things get worse further out into the summer when we get more people, more households starting to refinance at higher mortgage rates. But that does not detract from the fact that as of now, the housing correction has been far more modest than I would have expected. And I think most people would have expected. And that definitely lends a lot of resilience to the UK economy.
How does the Bank of England adapt and adjust to this better outlook on the United Kingdom economy?
Well, it allows it. I think, so here, how my thinking was. My thinking was we're going to have severe housing correction.
I think we've got some technical difficulties there. Vasilios, we're going to come back on that and see if we can reset the audio there and the linkage to the video with Mr. Giannakis. I just can't say enough, Lisa, about how people are allowed to be wrong and get a macro call wrong in the street and then be visible when they adjust. I think it's very different than a lot of our viewers and listeners perceive. You come out, you say you're wrong, you do 8 pages on what you got wrong, and you learn from that. And I find studying the people that were in the middle and didn't go this way or that way, or the people that just flat out were in the wrong vectors, always valuable.
Well, I would say that everyone's been humbled and then some over the past 2 years where everybody's gotten it somewhat wrong, including the officials setting policy. I mean, this has been an inflationary push that has been very difficult to understand, let alone the market's reaction to that. I think that we do still have Vasilios Giannakis of Citi. Thank you so much for bearing with us. I want to start, I want to go back to what Tom was talking about with this persistence of inflation or lack thereof. Jonah Henry of HSBC was saying that in the UK, there is a massive energy component. And so when you look under the surface, it's actually disinflating much faster than people would think. Do you agree?
I think I agree with that. There's definitely an element of disinflation that is coming from energy, but equally there is another thing that is very specific to the UK, and that's labor market shortages. And basically, this is what is keeping wage growth quite high, and the evidence has been the latest reading, which surprised everyone on the upside and pretty much spooked the Bank of England, and which is going to be one of the factors why they're going to pretty much hike 25 basis points today and potentially keep the guidance unchanged. So there's definitely an element of persistence. Part of it is due to idiosyncratic elements of the of the labor market, supply issues, labor market shortages.
So at this point, given that that is actually causing resilience in terms of people being able to spend, do you think that this Bank of England, that in general, central banks should err on the side of tightening more, of being over-restrictive to really get inflation the last mile down to their goal? Or do you think that it's important for them to be cautious, to take a step back, to not hike rates too far?
It's quite difficult to say this. I think it's quite difficult to say this right now because we are already way past the neutral rate, which means that monetary policy is quite restrictive. And this is where I see the dovest risk in today's meeting. that even some of the centric members may actually bring very prominently the issue of monetary policy transmission, essentially saying we've hiked a lot, we're going to hike one more time, but let's signal a pause because we want to see how monetary policy transmits into the rest of the economy. Again, my central scenario is for unchanged guidance, but I see the risk as emanating from centric people aligning a bit more with the Dovis members.
Vasilios, thank you so much. Greatly appreciate it this morning, particularly with the technical challenges that we had. Vasilios Giannakis, he is with Citigroup this morning. We're going to do Disney at the bottom of the hour, but I think we got to touch on it right now. In my youth, Disney was the buy. I was watching a movie last night. It's a spectacular movie on YouTube. I'm sorry, I can't remember it's like Hollywood without the makeup. And it's candid videos. And the guy that took it was legendary, and he had his two daughters and Walt Disney on a cart at the Disney Studios. Literally they were building out Disneyland. I'm thinking this is like 1952 or 1953. And so this is this iconic company, and to be abrupt, they're flat on their back. There's no polite way to put this.
Well, they are segmented, right? They're not flat on their back with the Disney World side of things, the Disneyland side of things. But when it comes to getting subscribers and growing their subscribers in a very competitive market, they're falling short. And it seems like that's really driving some of the negativity going into the rest of the year and, frankly, in the share prices.
I just think it's a streaming thing. I mean, we had one of our team just go down to Orlando and survive. The marriage survived. They were there for 4 days.
Congratulations.
They had to mortgage the house. They had a summer place they had to unload, I think, just to get, you know what it costs per day, like 4 or 5 kids?
Yes, actually, I do.
To go. It's painful. Well, so they're making money at that.
Yeah, they're making money at that. What we're seeing right now...
Mandalorian, not so much.
On the media side of things, there's a transition right now going on between streaming and cable. And cable, actually, the advertising is paying less, so they're getting squeezed on that side. And then on streaming, it hasn't gotten fully adapted yet, and we don't understand exactly how to make the money in such a massive way unless you just jack up prices for subscribers. And subscribers are getting used to it, but they're kind of pushing back. And so at what point do you shift completely and then maximize profits on the streaming side? We're not there yet. And we see all the streaming services struggling with this model.
I would say that Gina Ranganathan is excellent on this at Bloomberg Intelligence, quoted worldwide. And if you go to like the Hulu page or the Disney Plus page, whatever, we're getting back to bundles. We're going back to what we knew as kids, where you get Disney or Disney Plus, or you get Hulu, Disney, ESPN, all bunched in together. And the reports I got off the call yesterday is people are like, maybe not.
So remember a year ago when we were talking about content being king?
Oh, yeah.
Remember how everybody was taking out money to invest in tons of productions, and now the content we have is good enough. Too much content out there. We're not going to pay up, and there's a lot of a different tone now.
But don't you think that is an issue here? I mean, there's just so much. Who's got the time to watch it all?
I've got so much time. I just go home the rest of the evening. No, I mean, I take your point. I hear you.
We're going to cover this in more depth in 30 minutes here. The path here is to greet the Bank of England, and then we'll look at Disney at the bottom of the 7 hour and really lean forward into James Diamond and a conversation in the 8 o'clock hour. Stay with us on radio and television. This is Bloomberg.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. that's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Inflation is headed back to goal, but they have to be confident that it's headed back to 2%.
We've seen the noise in the data, right? Like 1 month doesn't make a print.
There are some risks still on the downside in terms of the economy. At the moment,
it really does just come down to the stickiness of core services inflation, and that's the inflation that's worrying for the Fed.
The CPI headline inflation rate will be below 4% by June. We're pretty confident.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. The Bank of England does something we've never seen in the MPC's history. It is the biggest upward revision to the gross domestic product of the United Kingdom. That shows some of the dynamics. Giannakis, Lisa, let's get right to it. Giannakis was brilliant there on the housing analysis that he got wrong. There was a belief in United Kingdom housing cratering. It did not.
Well, just to put this into perspective, the Bank of England was expecting a pretty deep recession. They were expecting to hike into weakness. It would be a significant length as well. Now they expect the UK economy to avoid a recession, delivering, as you said, Tom, the biggest upward revision to GDP in its history. This is the question, though. How much are they going to have to raise rates? They raised for the 12th consecutive time, 25 basis points to 4.5%. That was in line with projections. But this strength, does that mean that they are doing less with respect to hiking, or does that mean they have to do more?
Fractionally on the sterling call, looking at sterling dollar, cable is an even 126 right now, fractionally stronger out to 4 decimal points as well. Euro sterling showing the same validation of a sterling stability, a sterling recovery there with the economy. In the United States, red and green on the screen here. Dow a little bit negative. SPX up actually a nice 0.2%. Mohamed El-Arian out saying as we get close to this interest rate decision, the debate is a sign, the healthy debate is a sign of a healthy institutional strength. And this headline I don't think is minor, Lisa. The idea of a younger institution, the Bank of England without the Fed history across the 20th century. Bank of England delivers biggest upward revision in history is something that we'll have to hear from the governor further.
Just to bring some more detail to it, the vote was 7-2, as it was last time, so more in line
dissenters.
with expectation.
Probably Jim Bullard.
Although we'll be getting more details about what those were. To give you a sense of what that economic projection is, the Bank of England expects the UK economy to grow by 0.25% this year. They previously saw a 0.5% contraction. And the year after, in 2024, they expect a growth of 0.75% after previously seeing a 0.25% contraction. So this is a firm growth kind of trajectory at a time when people really were expecting the worst.
And again, the inflation risk, quote, skewed significantly to the upside. She's recovered from her coronation coverage. Our Bloomberg Surveillance royal correspondent Lizzie Burden is in London today looking at the Bank of England decision. Lizzie, give us some color here on the quality of the dissent at the Bank of England.
Well, it was a 7-2 split, Tom, but that's exactly what we were expecting. Swati Dhingra and Silvana Tenreiro have been the doves in previous decisions. Silvana Tenreiro has been telling us that you'd be a fool in the shower to be hawkish right now. In other words, don't turn on the hot tap. When you need to be patient for the warm water or you'll scold yourself. She's worried about the monetary transmission lag. She says it's 18 months to 2 years, but she's been ignored, overruled. The committee went for 25 basis points, yet another hike, because of course we have got double-digit inflation here in the UK. But interestingly, the committee is changing its outlook for inflation on the back of that recent double-digit upside surprise. It says that inflation is going to fall more slowly, not what the Prime Minister Rishi Sunak wanted to hear. Remember, his number one priority is halving inflation by year end. But he will welcome the news, as you say, of this biggest upward revision in MPC history to the GDP forecast. No recession on the horizon for the UK, says the BOE.
Lizzie, is your take, or is the implication here going to be that this Bank of England has to do more because of this slow process of declining inflation? Or is it that the Bank of England will be more patient, will wait for the hot water as they try to avoid some sort of deep recession?
Well, if you look at market pricing, traders have added to their bets. So now they see 4.95% by September. We were speaking to former Bank of England rate setter Sushil Wadhwani on Bloomberg Radio yesterday. He said that would be an unwise move to take rates that high, given the potential spillover effects from your side of the pond of a US recession, given all the regional banking turmoil over there. We'll have to wait for the presser, I must say, to see how confident the Bank of England Governor Andrew Bailey is on the future path rates. I really want to hear how much weight he puts behind these forecasts. Remember, in previous decisions, they told us we were having a recession, but that was predicated on the market path for rates, which they didn't endorse. I want to know, do they believe these forecasts?
Lizzie, Dr. Tenreiro of Argentina and the United Kingdom was on my panel at the International Monetary Fund, and she really underscored that this is not the United States of America. It's an entirely different economy, different process. From where you sit and with your BOE team in London, is it fair to compare and contrast the Fed with the Bank of England?
Well, the Fed has had the luxury of being much clearer in its signalling that a pause is yet to come. But economists that I speak to say that it would be perhaps unwise, it would lose the credibility of the BOE if they did anything but say that the future path for rates is data dependent. That's the sort of tone that we're expecting from the governor at the press conference at the bottom of the hour. In terms of the difference between the UK and the US, look, the timings of all of this have been different. There are base effects that separate us from the Eurozone in terms of when we were adding the energy price cap. But Bloomberg Economics says that you are going to see a conversion later in the year. It's just right now that it looks such an ugly split between the Eurozone, the UK and the US.
Lizzie Burden, thank you so much. Economics outside of the Bank of England here after this announcement. Against sterling on 126 level, 125.94 right now. I'm going to call it pretty much unched here off the decision. Again, maybe it's that two dissenters as we have seen before. Further on this, Sarah Hewen joins us right now, head of Europe and America's research at Standard Chartered Bank. Sarah, Citigroup says they got wrong the housing question. Explain to our international audience the resiliency of the United Kingdom housing economy. That's been a game changer here, hasn't it?
It has so far, and it's a big challenge for policymakers because the resiliency has in large part been due to the fact that many people, they're on fixed rate mortgages. We know those mortgage terms are going to become significantly more onerous in the coming months. But so far, we've actually seen, if anything, a recovery in housing activity in recent months. But ultimately, the higher cost of borrowing is going to weigh very heavily on many households, and that impact just hasn't come through yet. So it's this question about timelines more broadly. If we talk about how the Bank of England policymakers take their decisions, how far do they take into account the extensive policy tightening that's already happened? They've obviously decided today that they still need to do more to bring inflation down.
Sarah, I'm looking right now at what Lizzie was talking about, that right now traders are expecting key rates in the Bank of England to peak at about 4.95% in September. That is up from 4.5% currently, so basically 2 more rate hikes. Does that cohere with this idea of expansion this year and next in the UK economy, as the Bank of England now expects?
Yes. I mean, interestingly, if we look at what the Bank of England is expecting for inflation, they have nudged up their inflation forecast 2 years hence, 3 years hence, but they still see inflation coming well below target.